Okay, good morning, students. Today is 7th of January 2021, and we are going to cover the topic, the subject, Strategic Financial Management. And this is the fifth lecture. We have covered a lot of grounds. We have covered, basics. We have covered the futures, forwards, and today we'll be covering some questions on futures, and then followed with the options. Now, options is a very tricky topic. Of course, the whole of the subject is such like that, but the options is the most difficult for some people. So please focus so that you can understand it better. Okay, and we are going to cover basically the foreign exchange exposure and risk management, and I am CA Pravesh Agi. So let's begin with the lecture. To start with, we will be doing some questions which on futures. So we were left a little bit unfinished with some of the examples. So we'll be doing that. So I hope you have your PPTs with you. Let's begin. So we are doing currency futures market, and the topic which we are going to cover is the futures, and we'll be doing some questions directly from your study material. Okay, so this is exercise number 3. So let's begin. Now, this is basically a company, XYZ Limited, is an export-oriented business house based in Mumbai. Okay, so he's basically an exporter. The company invoices in customers' currency. That is normally what it does. It receives its receipt of a US $1 lakh is due on 1st of September 2009. Okay, so they are going to receive $1 lakh, which is going to be on 1st of September 2009. So market information as at June 1, 2009 is given. Okay, so this is the information. Okay, so which is right available on your screen. I'll just set my video bit with side. Okay, now it says that there's a table given on your screen which says that exchange rate on your left hand side we have the exchange rates. Okay, so US dollar oblique rupee is the spot rate is 0.02140. Now this is an indirect quote. That means $1 is equal to how many, not how many rupees, but 1 rupee is equal to how many dollars. So this is an indirect quote in India. So that quote has been given here. 1 month forward rate is also given, and 3 months forward rate is given. I made it red. Of course, in your question it will not be like that. But since the money is going to be received on 1st of September, and today is 1st of June, so that means we will look for the 3 months forward rate, which is given to you here. Okay, just to make you understand in simple manner. So I've highlighted in red color. Now let's go to the currency futures. So we are going to use futures here. So again, the quote which is given in indirect quote, which is June quote is given, and September quote is given. And September, I made it red because the money is going to be received in September. And the September quote says that the dollar is 1 rupee is equal to $0.02118. So this is the September. This is at which the September future is trading at the moment. Okay. So if you open the stock exchange, you will find this is the rate which is available. That now the contract size is 4,72,000. Since it is given in a reverse quote, so it is not in dollars, it is in rupees. Okay. So we have to be careful while solving it. Okay. So initial margin, which person when he takes a position in the futures market, he has to pay a margin, which we discussed in our earlier lecture. Okay, so if he is going to enter a June contract, he's going to pay 10,000. If he's going to enter into a September contract, he's going to pay 15. So 15,000 is more relevant. So this information is additional, which will not be used. Now the interest rate is 7.5% in India and 8% in India in September. Now since the margins are paid upfront and they get released after the expiry, so we have to work out what is the interest cost a person will be incurring. Okay, so that for that it is been given. Fine. So any other information? Now I think it's very clear. All the things are given to you. Okay, so on September 1st, that means on the day when the payment is going to be received, okay, as an exporter, the spot rate is given as 1 rupee is equal to so many dollars. So this is the spot rate. Okay, and the currency future rate is also given. Now normally we always take this as 1, but in this case this is the spot rate. Now it can be a future rate which can be calculated on the weighted average rate of the last half an hour closing in the market. if it is not the expiry. So this is maybe a rate, the difference is because of that. So the rate is, currency future rate is this, and the spot rate is given to you as 0.021133, and future rate is given as 0.02134. Comment, which of the following methods would be most advantageous for the company XYZ? Using a forward rate, using currency futures, and not hedging the currency risk. So he has got three options: either to go for a forward contract. Okay. The second option is he can use the information which is available, go to the stock exchange and use the currency futures hedging technique, or he can just leave his exposure unhedged. So these are the three options available to him. So now it may be assumed that the variation in margin would be settled on maturity of the futures contract. So that's why you pay the margin, and that gets settled only at the time when the contract is squared up, or finally you close the contract. So let's begin to solve this question. So now the first is the simple one. So we will be okay, Sumit, Jan and Chavi have joined. Okay, good, fine. So receipt using the forward contract. The first one, which is the most simplest one, the forward rate, a 3-month forward rate is given to you in the question. Okay, so I highlighted that. So this is 1 rupee is equal to dollar so much. So I've written in a proper format here. So now we can just simply, because it's an indirect quote and we have to receive, $1 lakh. So this quote is in rupees. So we can simply divide this to calculate the amount what he will be receiving after 3 months. So it comes to 47 lakhs 1,457. Okay, I'll be solving these questions on the question on the board also if it finds that there is something to do that. Okay, so I think up to now I should be very clear. So 3-month rate is given. Okay, fine. And then it can be alternatively, we can just divide 1 divided by 0.021 and convert into a direct quote. So we know that $1 is equal to 47 rupee 1. So this is little old code. So because it talks about 2009. So at that time, $1 was equal to 47.01. So this is basically a forward quote. So we can just simply multiply $1 lakh into 47.014 and calculate the same amount. Okay, so there are two ways. First is, if you are very familiar and become expert, you can just simply, it's an indirect quote and you can divide it and calculate. And if you want to still be comfortable and calculate into a direct quote and then do your calculation, so you can do the second method where, you divide 1 divided by you do the reciprocal of the quote, convert it into a direct quote and multiply it with the dollars. Okay, and you will get your amount. So this is the forward rate option. I hope you have followed. So, okay, good. So this is the forward rate. Now let's use the currency futures. Now this is, please be very careful and listen to this. Okay, this is very important. So the number of September contracts needed is, we know that, the total value is $1 lakh. And the September future is trading at 0.02118. So it is equivalent to 47 lakh 20,000 as per the September quote. So each contract is of 4,72,000. So we can just divide 47 lakh 20,000 by 4,72,000 and we get 10 contracts. Okay, fine. So it's been just done in a reverse manner. Otherwise, we take a lot size of $1,000, as you know, in the futures market. But since the quotes have been given in reverse order, in indirect quotes, so we are trying to convert and find out how many contracts will be needed to cover your futures. Now, initial margin is payable upfront. Now, there are 10 contracts we know, and for each contract, the margin is 15,000, which is given in your question. So the total margin which will be paid upfront will be 1,50,000. So that margin will get released only on, say, 1st of September. So he takes now, he's an exporter, isn't it? So as an exporter, he is actually long in, in his underlying transaction. So he should take a short position. Right, in short position in what? Dollars. But since the quote is reversed, so he has to take a long position on rupee, which is equivalent to taking a short position in dollars. So remember that. Okay, so that's a catch here. So he's taking a long position. Though he's an exporter, his actual position in the real transaction is long in dollars, but he has to take a short position in dollars. Okay, so which is equivalent to a long position in rupee. So since the quotes are given in rupee, so we have to just do the reverse. So this is a catch here. So please remember, this is a very important thing. So he takes a long position on rupee for 10 lots. Okay, fine. So on September 1, the time, the expiry, the rupee closes at 0.02134. So which means the rupee has appreciated. Okay, the rupee has appreciated or the dollar has depreciated. Okay, so rupee has appreciated from 0.02118 to 0.02134. So that means since he has taken a long position, he has bought, so he will be making a gain. Okay, so he makes a gain. Fine. So since he's an exporter, he will be losing in the spot market because of the rupee depreciation, but he will be making gain in the futures market. Okay, so that is basically 0.0016. Okay, so that has been calculated. So this is basically the difference. So if you can, that is 0.02118 minus 0.02134. So he makes a gain of these many dollars. So now we have to convert that into how much rupees he's making gain. So profit would be multiplied by 10 contracts, and each contract's value of 4,72,000 rupees. So that means he'll be making a gain of $755.2. Okay, so which can be converted. When he will get this money, he'll get the money at the spot rate. Okay, say on 1st of September. So we apply the spot rate and calculate the amount as 35,406 rupees. Okay, now, I mean, of course, you will be wondering, that, since everything has been calculated in a reverse fashion, so you can do a cross check. Okay, the cross check is given here. So we know that when we started, if you would have taken a long position in dollars, so it would have been, the dollar would have been 1.1 divided by 1.0018. Okay, at the beginning. At the end, it would have been, at the close, it would have been 1 divided by, so this number is coming from here, and this number is coming from here. So this is, when he took a long position in rupee, so the dollar was at this level, and now it is this level. So that means the dollar was at 47.21, okay, when we do the reciprocal, and now it is 46.86. So which means the dollar has actually depreciated. How much? 35. So he would have taken a short position in dollars, he would have gained 35 paisa. So which would have been translated into a gain of 35,400, which actually matches with your answer which you have done. So please remember, this check is very important for you. If you understand and comfortable with the direct quotes, you can even check whether your answer is right. Okay, the only difference of 6 rupees, which is happening because of the spot rate, we have taken as 2 point, if you see the spot rate here, which is 2.33. Okay, whereas we have taken here as 3.4. So that is the only difference here you're getting. Otherwise, it is exactly the same. So I'll just repeat again. The number of contracts he requires would be 47,20,000 is the total exposure as per the September future contract size. So, and each contract, is of 4,72,000. So that means 10 contracts he has to take a position. Okay, since and he has to pay upfront margin, which is 15,000 rupees per contract. So that would be 1,50,000. Then he takes a long position on the rupee. Okay, being an exporter, he should have taken a short position in dollars. But since the quotes are given in indirect manner, so he takes a long position. So long position rupee is equivalent to a short position in dollars. Okay, so we look at the opening rate and the closing rate and the expiry rate. So, and we just minus it off, and we get that he makes a gain because the dollar has gone up from 0.02118 to 0.02134. So thereby he is making a 0.0016 a dollar gain per contract. Now we have to first of all calculate in terms of dollars, because he is making, this will be a dollar per contract. So that means on the whole contract, how many dollars he will be making. So we can calculate that by multiplying by 10 contracts, and each contract is size of 4,72,000. So then it comes to $755.2. Okay, then that all these dollars he will get at the spot rate. The spot rate happens to be 0.02133. That is the future spot rate. Okay, the spot rate on 1st of September. So we apply that and convert and calculate the money as 35,406, and then it has been actually been calculated the other way around also. Okay, I hope you are understanding. So here what we have done is basically we have checked it, that what was the dollar rate of the futures, okay, at the beginning, and what was the dollar rate at the end on the futures. So it was beginning, it was 47.2143. At the end, it was 46.86. So that means he has made a gain of 0.354. Okay. So this is the gain which he has made on the contract. So because he has taken basically a short position, okay, and the dollar has been reduced from 47 to 46. Okay, so since he has taken a short position, he'll be gaining if the dollar goes down. Okay, fine. So then he makes a gain, and this multiplied by the total number of dollars. So that means the total gain should be 35,400. So now let's see. So margin will be released in September. So September is where the margin is released. So interest cost on margin for 3 months. So margin is blocked for 3 months. Okay. So interest rate which is given in the question is 8%. Okay. And it is for 3 months we have to calculate. So on 1,50,000, the interest rate will be coming to 3,000 rupees. So this we should factor in while making a decision whether you should go for futures or forward or whatever. In futures you have to pay the upfront margin, so which cost you. Okay. So exporter now will get $1 lakh on 1st of September. Now 1st of September comes and he gets 1 lakh. He goes to the bank and finds that the spot rate is 0.02133. Okay. So he is going to convert his entire money into rupees. Fine. So he gets 1 lakh divided by 0.02133. So he gets 46,88,233 by giving a delivery of $1 lakh to the bank, and bank will give him 46,88,233. Now let's understand how much money he makes. So this is the money he will be getting from the exporter, and plus 35,000 rupees will be the gain from the stock market. Okay, because the dollar has depreciated, so he would have lost in his in the real transaction from the bank, but he makes a gain in the futures market. The minus 3,000 rupees, which is basically the interest cost on the margin which he deposit. So net he gets 47,20,639. So now we have the figure of forwards, we have the figure of futures, how much he's getting. So let's now compare. So receipt under different methods of hedging. First was a forward contract. So we know that the money which he got was 47,01,457. Now, when we look at the futures contract, he gets 47,20,639. Okay. And then, if he's not hedged, that means he's unhedged. So then, whatever is the spot rate prevailing, say on 1st of September will apply. So that rate is 0.02133. So we divide and find out, what is the amount he's going to get. So this third one is when he doesn't take any position. He neither goes to the forward market. That means he never takes a forward contract with the bank, never goes to the stock exchange and hedges himself in the currency futures market. So here, if he doesn't do these two, so then he will be, given in the money, when he gets the money in dollar terms from the exporter, from the person who is actually, taken his goods. So he'll give him $1 lakh. So he'll go to the bank, and bank will give him, money at the current spot rate, which is on 1st of September. The rate which is given in the question is 0.02133. So which is 46,88,000. Now, which one is better? 47,01,000, 47,20,000, 46,88,000. Of course, the futures contract is giving better. Most advantages is the futures contract. Okay. So I'll pause for a while. If you have any question. Yeah, definitely. Sumit, the interest cost on margin is an opportunity cost. Now, what happens is that since he's paying the margin upfront, okay, which is 1,50,000. So that money is blocked for him for 3 months. He could have used it for his business purposes since the money gets tied up. So that is an opportunity cost. We have to build in while we arrive at the correct decision, because in forward contract there was no money which was getting blocked. Even unhedged position, there is no any commitment of any money. Okay, say in 3 months. In this case, just to start with the futures contract, you need to pay a margin. So which is very appropriate that you have to factor in the interest cost. Okay, I hope you have following it. Chavi, Sumit, and all others who are on the line, have you followed? Because this was a very, very important question where the indirect quote was given. You are an exporter. Normally, I told you that an exporter who is long in foreign currency, he should take a short position in the futures market. But in this case, we have taken a long futures because the rate were in the indirect quotes were given. So that's why we had to resort to that. Okay, fine. So your knowledge will be tested on that level in the exams. So you should be well prepared for that. So now let's go to the second question. Okay. Now before we go to the second question, this is the way it has been solved in your study material. Okay. If you look at your study material, you'll find receipt using the forward, which is 47 lakh 1,000. So we also did the same thing. Receipt using the currency futures. So number of contract needed is 1 lakh divided by 0.022. So we get divided by 4. So we get 10 contracts. So this is exactly what we did while solving the question. Interest margin is payable is 1,50,000. Okay. So on September 1, the market closed at 0.02134. Okay, this was the futures closing, whereas the spot closing was 1 lakh divided by so much. So this was basically the spot rate on this thing. Okay, which means on September 1, he's going to get his money from the exporter. Okay, at what rate? At the spot rate. So the spot rate will be, if you do that, he will get 46 lakh 88,233. So this is the money which he has got from this customer, $1 lakh. He go to the bank and the banks, gives him at the rate of 0.02133. So he gets 46 lakh 88,000. Okay, and then the profit on basically the margin on this trade in the stock exchange, which has been referred to as variation margin. So which is the difference between the two rates, which is 0.02134 minus 0.02118 multiplied by 10 contracts, multiplied by the total overall rupee per value of the contract, and divided by the spot rate. Okay, so he will get his profits at the end of the 3 months at the rate which is prevailing in the spot rate. Okay, so he will get 35,406. Fine. So then we took the interest cost, which is 3,000. Okay, which is 8% for 3 months, and the net receipts will be 47 lakh 20,000. So this is also what the answer we got. And then we consider all these receipt under different methods. So forward contract is 47 lakhs, futures for 47 lakh 20,000, and if he was not hedged, then it was 46 lakh 88,000. So we see that the most advantageous option would have been to hedge with futures, where he got basically the highest amount of money, because he's an exporter. So he would be more interested in how much money he's getting in maximum, where he's getting. So he's getting in the futures contract. Okay, so that is a futures contract. Yeah. So we also did the same thing. Okay, if you remember, most advantage is the futures contract. Okay. So if you have followed it, so please, if you have any queries, so I'll just give you half a minute to pause. So if you have followed, say yes. If you haven't, tell me your area of concern so that I can resolve it. Okay, so otherwise we'll move to yet another question. So I'll give you half a minute for that. Okay, so I believe that you have followed it. Okay, so let's move on then. So we are doing, exercise number 3 today now. Okay, fine. So here, there is a company called Zaz. I'll call it Z. Okay, Z PLC, a UK company, is in the process of negotiating an order amounting to euro 2.8 million with a large German retailer on 6 months credit. Okay, so this is a company Z PLC. Okay, it's a UK based company which is in the process of negotiating an order amounting to euro 2.8 billion. Okay, so 1 million is equal to, remember, is 10 lakhs. So with a large German retailer on 6 months credit. So that means they're going to receive the money after 6 months. Okay, so they are exporter. So if successful, this will be the first time for Z has exported goods into a highly competitive German market. So the Z is considering following 3 alternatives for managing the transaction risk before the order is finalized. Okay, so I got the answers from Chavi, Ambika, and Pujita. So they are saying yes, followed. Okay, good. So definitely. So that was a great kind of comfort feeling for me, because the question was in a different order. So if you followed it, it's great. So I mean, I'm happy that you're learning. So now, there are three alternatives in this question. Okay, so which we have to choose which one is the best one. So Mr. Peter, the marketing head, has suggested that in order to remove the transaction risk completely, Z should invoice the German firm in sterlings using the current, the dollar pound average spot rate to calculate the invoice. So remember, we were doing some internal techniques where, if a company raises, the invoice in its home currency, then, the risk is transferred to the other person party. Okay. So here, Peter, who is the marketing head, he says that, we should, invoice invoice that in pounds, okay, instead of euros, so that we don't eliminate the forex risk. Okay, so at what point it will be done? It will be done at the average spot rate. Okay, so whatever the spot rate, we will do the average of that. So this is what Mr. Peter thinks, that we should not have any kind of a risk, and we should invoice it in terms of pounds rather than euros. Okay, so now we come to another person, who is Mr. Wilson. He is the CEO of the company. So he is doubtful about Mr. Peter's proposal, and suggested an alternative of invoicing the German firm in euros. So he says, no, we should invoice in euros and use a forward exchange contract to hedge the currency transaction, to hedge the transaction risk. So he says that no, it is not possible to raise the invoice in sterling, but rather we should use a forward contract to hedge our risk. Now we have the CFO, Ms. Karen. Now she agrees to the proposal of CEO. Okay, fine, but to invoice in German first, in euros. But she's of opinion that Z should use the sufficient 6-month sterling further contracts. Now, maybe in England it's called further contracts. It's nothing but futures contracts to the nearest whole number to hedge the transaction risk. So net, what the CFO is saying, she's saying that we should invoice in euros, but we should use the futures contract, 6 months contract, because the money is going to receive after 6 months. So we should go to the stock exchange and use the futures contracts to go to the futures market and hedge the transaction risk. Okay, and to the nearest whole number, whatever is it can be either overhedged or underhedged, because sometimes I told you in the futures, because it is a standard market. So she said, okay, to the nearest whole number we should hedge. Fine. So following data is available. The spot rate is 1 pound is equal to so many euros. The bid and ask rates are given, which is the spot rate, and 6 months forward points are also given, which is 0.60-0.55 euro cents. Now, if you see this code, the bid is more and then the ask. Okay, so normally it is the other way around. So we're suggesting that the pound is trading is depreciating against the euro. Okay, so we will be minusing these instead of adding to the spot rate. 6 months further contract is currently trading at, so this is basically the futures contract. This is trading at euro 1.1943 per pound. So 1 pound is equal to so many euros. So this is the futures contract. 6 months contract is currently trading at. 6 months future contract size is 62,500 pounds. Okay, so each contract is for 62,500 pounds, so which is pretty large. Okay, fine. Because in India it is 1,000 pounds. Okay, so there the contract size is much higher. So after 6 months spot rate and the future rate, which is the same, which is given as pound is equal to euro 1.1873. So after 6 months, both the spot and the future rates are same. Okay, fine. So you are required to calculate to the nearest pound the pound receipts for Z PLC under each of the 3 proposals. Okay, so we have to evaluate all the three proposals and find out which one is the best one. So in your opinion, which alternative you consider to be the most appropriate? So this is what the question is. So let's begin answering this now. So first is invoice the German firm in sterling using the current euro pound average spot rate to calculate the invoice amount. So this was proposal by the marketing manager that we should use the sterling as the currency to invoice the German firm, and we should use the average spot rate. Okay, so we know that this is the proposal of Mr. Peter, who is a marketing head. So invoice in pounds will produce what? Will produce the amount to be received from the German company is 2.8 million euros. Okay, so we divide this by the average rate. Okay, so look at the last slide, last part of this thing. So average rate is it has been given that if you see the average rate in the question, it is given, it is that 1 pound is equal to 1.1960 dash 1.1970. Okay, so these are the two rates, the bid and spot rates. So we just add them, divide by 2, so we have the average rate. Okay, so now we take this average rate, and since this is this is an indirect code, 1 pound is equal to so many euros, but we have euros. Okay, so we will divide this by the average rate to arrive the figure in pounds. So if you remember that this is 1 pound is equal to so many euros. Okay, but we require a quote which should be how much 1 euro should be equal to how many pounds. So we can convert that, or we can just but in this case, because he is talking about the average rate, so even this is not to be considered here. So we'll be simply using the average. Here there is no issue as such. Okay, because he talks that it is an average rate. Okay, so only in the forward rate we will do whatever I was mentioning now. So we can just divide this 2.8 divided by 1.965. So, but we'll be dividing it because it's a reverse code. Okay, so to calculate the million. So if we divide and using the calculator, so if you use the calculator, 2.8 divided by 1.1965, so we get 2.340. Okay, so this is in pound million. Okay, I hope you are following it. Okay, so so this is what he will be getting. They will be getting if it is invoiced in pounds. Okay, so now let's go to when using a forward exchange contract. Okay, so this is the most easy, and always it's very easy to find out how much money they will be getting in the through the forward exchange contract. Okay, so now proposal of Mr. Wilson. Now the forward rate. How I have calculated is I have taken the rate as which has been given in the question. It is 1.1970. So I'll expand it. Okay, so look at the bottom of the screen. Okay, so this is the rate which has been given in the question. So 1 pound is equal to so many euros. Fine. So since the swaps is basically the points are in reverse order, we'll be minusing. Okay, so we minus at both the sides. So we get and we get the rates here. So it is here what we do is that we take this 1.1960 minus 0.0060, so which is coming now on the ask side, and this figure is coming on the bid side. Okay, so 1.1915. So since he's going to get his pounds, okay, he's going to get his euros and goes to the bank and to sell it, so the bank will give you money at the ask rate. Okay, so the forward ask rate is 1.1915. Okay, so since it's a reverse order, so we will divide it by to calculate. So this will be 2.35 million. Okay, so I'll just repeat this again if there is any confusion. So the forward rate, what we have done is we will look for the ask rate, because he's an exporter, he's going to get the money, so he goes to the bank. Okay, sorry, not the ask rate but the bid rate. Sorry, so here it will be the bid rate. Okay, so it will be the bid rate which will be important for him. Okay, so he will be looking for the bid rate because he goes to the bank, he wants to surrender his euros, okay, and convert them to pounds. So the bid rate will be relevant, not the ask rate. If he has to buy, then the ask rate is relevant here. Okay, so he checks it with the bank. The bank gives him a rate 1.1970 minus the swap points. Okay, so which is 1.19. So use this rate to convert into the foreign into the pounds. So he's going to divide because it's in the indirect quote. So he gets 2.35 million. Okay. Now how we arrive at the rate? So the rate is, we know that one pound is equal to so many euros. Okay. So since this was a spot rate, so we minus the swap points, which is 0.0060 and 0.055. So then we do the reciprocal of this. Okay, so to convert into €1. Fine. So €1 will be which will be 1.1970 minus 0.0555, which will come here, and 1.1960 minus 00 will come here. So, but we are using this, so which is the bid rate. Okay, so 1 divided by 1.195. So we have used this here to calculate our forward money is will getting in pounds. So hope you have followed. Okay, okay, have you followed it? So please say, otherwise if there's any confusion I can repeat. Okay, so now okay, so there were two more information which I missed. So the spot rate is given and the 6 months forward rate points are given. So we use those points to calculate the forward rate. Okay, so these are given in your question: the spot rate, the 6 months forward points. Then we use them to convert. Okay, and then we use the appropriate rate to find out what would be the money he'll be receiving in pounds. Okay, so so Z should use sufficient 6 months sterling further contracts to the nearest whole number to hedge the transaction risk. Okay, so this was okay, good. Ambika, well, yeah, definitely. I just made a mistake by calling it ask rate, but actually it was the bid rate. So you have followed it, fine. So Z should use sufficient 6 months sterling contracts to the nearest whole number to hedge the transaction risk. Okay, so proposal of the CFO. The equivalent sterling of the order placed based on future price. So future price is given to us in the question, which is pound, which is euro 1.943. Okay, so this is the future price which is prevailing after 6 months today. Okay, so we'll find out that what will be in terms of in pounds. So 2.8 million of euros divided by 1.1943. So it will be equivalent to 23,44,470 pounds. So now we will calculate the number of contracts. Okay, how many contracts are required? So we know that the total exposure is 23,44,417 pounds, and each contract size is 62,500 pounds. Okay, so we divide this by say 62,500. So we get 37 contracts nearest to the whole number. So if you do the revision, so I'm doing it now again: 2344470. Okay, 2344470 divided by 62,500. So which means it comes to 37.51. Okay, so the nearest whole number could have been 38 also, but he has taken 37. Okay, so that means there is slightly under hedging. Okay, fine, but he says CFO says that you use to the nearest whole number. Okay, so we'll go by her advice and take 37 contracts. So if the 37 contracts are taken to hedge this transaction, then the future contract will be of the value of 37 into 62,500, which will be 23,12,500. Okay, so total exposure in terms of euro was 2.8 million, which is translated into pound, which was 23,44,000, but they are actually taking a hedge for only 23,12,500 pounds. Okay, so which means under hedging. Okay. Okay, so then so buy our future. Okay, so this again remember here that he's what? He's an exporter. Okay, and he would actually take a long position in euros. Okay, or he can even he's an exporter, so he'll be taking a short position in euros. or even a long position in pounds will be good enough. Okay, so here the quote is also given in the reverse order, where 1 pound is equal to so many euros. So he has to take a long position in pounds instead of taking a short position of euro, which is the same. Okay, so he goes long in pounds. Fine. So at the expiry, the rate is 1.1873. Okay, so he took a long position in pounds. Okay, but the pound has gone down to 1.1873. So that means he'll be losing money. Okay, so there's a loss. The difference is the loss. That is 1.1943 minus 1.18373. Okay, so yeah, so the question say here also the long position of absolutely. This is also most of the time in CA you will get the questions which will not be in direct nature. So where instead of, as I told you, that as an exporter you should be taking a long position, okay, in the foreign currency. Okay, there in the example we did was dollar versus rupee. So you're taking a long position in rupee, in dollars. So here the foreign currency is euros, so you should have taken actually a short position in euros. But since the quotes are given in such a way that he has to take a long position in pounds, okay, which is equivalent. So don't worry, because I mean it's a simple thing once you understand the concept. So he makes a loss. So since he has taken a long position in pounds, okay, so and the pound has gone down, okay, from 1.1943 to 1.183. So he will be making a loss of 0.03. So now let's convert this loss. So some more information was there which I didn't share. So the 6 months further contract is currently trading as 0.1. So this we have used here, okay, for calculating. And this also we have used there. So he has bought futures. And after the expiry, the rate was 1.1873. So this is from the question itself. Okay, so there was a loss. So let's now look at total loss. Total loss on future contracts. So how many contracts were there? 37 contracts. Each contract sizing 62,500 pounds. Now for each contract you have lost 0.0070 euros. So that means this is the amount of total loss in terms of euros, 16,188. So this is the money which you have lost in terms of euros. Okay, fine. By taking a futures position. So so that means after 6 months, when he's going to receive the money, he's going to receive 2.8 million, which is nothing but 28 lakhs. So this loss will has to be adjusted. So he will be getting in totality, though he will be receiving 28 lakhs euro, okay, from the customer, but he will be losing euro 16,088 from the stock market. So overall net he will be content with 27,83,812 euros. So if we convert that as per the spot rate which is prevailing today, so which is 1.1873, okay. So since it's a reciprocal quote, so we'll divide it, okay, and since it's an indirect quote, so to convert it to pounds, so we get 2.3446. Okay, so what we have done is basically, so we have taken 27,83,812 divided by the spot rate after 6 months, which is 1.1873. Okay, so the amount which he gets is 23,44,657 is the total amount. So divide by 10 lakhs, so this will be 2.3446 million. So that is what he gets using a futures contract. Okay, fine. So this is the money he has got, and the 6 month spot rate is given to you, okay, in your question. So we use that to convert the euros into pounds. Okay, so now let's see how much he gets. So I'll just make it animated so that one by one it falls. Okay, so no problem. Yeah. So there are three proposals. The first proposal was basically proposal A. which is invoicing in pounds. So how much he gets? Pound 2.34 million. The second proposal was hedging through forward contract. So we have seen that he has got 2.35 million by using a forward contract. Then the third one was hedging through futures contract. Okay, so he got 2.3446. Now, where is getting the maximum? Because he's an exporter, so he'll look for basically the place where, so proposal B, which is basically hedging through forward contract, is preferable because A and C produces the least receipts. Okay, so if you're followed, please say yes. If you have any query, please ask me. Now there's another point which is to be mentioned here, that the first proposal, which was invoicing in pound sterling. So further, in case of proposal A, there must be a doubt as to whether this would be acceptable to the German firm, because it is described that the company is for the first time entering into the competitive market. Okay, so German firm, as it is described as competitive market, and Z is moving for the first time. So already the market is very competitive. Okay, so how can your German company can accept that you should bill in your own currency, and he takes that the exposure in pounds. So he'll not be interested in take the exposure. So this is the first proposal will be always be under a doubt. So that you can always mention as an additional point in your answer. So I hope you have followed. Okay, so if there is any questions, please ask me. I'll just pause for a second because we have almost finished the two important questions. If there is anything left, no. So this is the question which we did, the two questions we've done in the futures market. Okay, so before I start the options market, so I'll just give you a pause for a couple of seconds more. Okay, is there any issue? Please let me know. So then we will be, moving to the next question, to the next topic. Okay. Okay, so we'll close and move on to the options now. Okay. So I'm just opening my slides for the options this thing. So yeah, I've located it. So this is the slide number 7. I hope you have got your slides with you. So we are going to start the options now. Okay, I'll share the screen. I hope you are able to see the screen, okay? I have a slide out, so please confirm whether you are able to see the screen. So we are going to cover the options now. Okay, very good. Are you able to see the slides, please? So please confirm. Okay, so the topic which we are going to cover today is currency options now. Now, this is, one of the very, very, tricky part of the derivatives. And some very difficult questions have come in your exams. But if you understand these options carefully, since you have understood the futures properly, then options is not a big game. Okay, and so I would say that give maximum attention while understanding what are options. So today we'll be covering a couple of very important questions which have come in your exams, as well as okay. So before we do that, I've got a question from Preeti. So why would a person take a futures contract when future rates with swap points is lesser than the forward rate? In practical life, we do check all the alternatives, and amount involved is huge. Yeah, definitely, because when the future swap point is lesser than the forward. Now, why so? Because if you're getting the money, if the forward rates are showing a depreciation, okay, so that because you're getting your money after say 6 months or 3 months, so even if your suppose let's talk about dollar rupee. If the dollar is going to depreciate, say 3 months time from now, if the rates are suggesting, so if you're going to receive money from abroad, you are going to get less anyway, whether you use a forward contract, whether you use a futures contract, whether you use a money market hedge. So you still explore all options that where you are getting the highest. So the swap points is not basically telling you whether you should take a hedge or not. Okay, if the currency is depreciating or appreciating, okay, but we have to see if you are an exporter, which is giving the maximum in terms of the foreign currency, in terms of your home currency. Okay, and as an importer, you look at how much you're getting, how much you are, where you're paying the least. Fine, whether the currency is appreciating or depreciating, it doesn't matter. Okay, because you are just comparing all the options in hand. Fine. So maybe I think you have followed, I don't know, but we will talk about. Okay, no PPT is visible. Okay, so I'll just make the PPTs visible. Okay, so now I think it should be visible. Okay, is it visible now? Okay, so I'll just check myself. Okay, so I think now should be visible. Okay, so currency options. Okay, so let's begin. In case if it is not visible, please let me know, but I'm just starting. Currency options. So what are currency options? So let's understand the value of currencies keep changing. We know that the value of the currencies keep changing about one another. Okay, so the currencies keep changing depending upon the host of situations. It can be the economic growth, it can be the political developments, it can be the central bank policies, or so on. So because the currencies keep changing, and it can happen because of the economic growth happening, whether the country is growing or not, whether depending upon the political development taking place in the country, or sometimes the central bank policies like RBI or the Federal Reserve in America. So their policies also affect and fluctuate the currencies. So there's a lot of volatility which happens in the currency. It can be caused because of many factors. Now these fluctuations affect both importers and exporters, whose fortunes depends to a considerable extent of the value of the currency. Now, if you're an importer and exporter and the value of these currencies change, so you can be greatly impacted. Okay, as we know, the value of the company can go up and down because of this. The economic exposure, if you remember. To guard against these fluctuations, they use derivatives like currency options and futures. Of course, it is not just the importers and exporters who trade in these. Even the speculators too are very active participants, also hoping to turn on a profit from the movement of exchange rate. So there are lots of host of players. I mean, the people who have underlying positions like importers, exporters, or the people who are going to receive money from abroad by providing some services, or they are going to make some payments abroad because they have received services from abroad. So apart from all these people, there are speculators also, and most of them, mind you, are speculators. Almost like 80 to 90% of the people who are present in the stock exchanges are actually the speculators and not the hedgers. Okay, so a lot of all these fluctuations can impact all of these people. Now, how the currency options work? So before even explaining what is the nitty-gritty of options, so let's understand through an example first. Okay, fine. Information technology company, Infosoft. Clients are mostly in USA. So there's a company called Infosoft. who is basically an Indian company. Okay, and most of its clients are in USA, and its earnings are in USD. Definitely, because it is an Indian company and it is selling its software to US, so all its earnings are in USD. Expects the value of the INR to increase to 70 from an existing of 74. So if you look at today's rate, it's 74. Suppose it goes to 70, then when they convert the dollars into rupees, so they will receive 4 rupees less. Okay, so they expect this to happen. Normally it is the other way around. The US dollar appreciates. Okay, so they think that the INR is going to appreciate in, say, coming few months because of whatever situation they foresee. So in this case, the company is going to lose money. Okay, so this will mean losses since the company has to repatriate its earning in INR from USA to India. So since the money will be brought to India, so they will be losing money if they bring it at 70 as against 74, which is prevailing now. A stronger INR will translate to a lesser money in its kitty. To offset this, Infosoft decides to purchase currency options. Now, in this case, they're using currency options. That gives the right, but not the obligation, to sell the INR at 74. Okay, so that means they are going to the currency market, they're going to the options market and purchase a currency option contract, which will give them the right, but not the obligation. Remember, but not the obligation to sell the INR at 74, which is the current rate. Okay, and which is also called the strike price. And we'll soon understand what is strike price. Okay, so options contracts are like this. I just compare it to if you are hoping to go and watch a movie. Okay, so you purchase a ticket and you spend 500 rupees for the balcony, and you purchase a ticket for going to a movie. And then it is going to happen, say, next 2 days from now. So, but you learned of the reviews of the movie, and somebody told you that this movie is not good enough, so you should not be going, because you'll not be able to spend even 15 minutes there in the cinema hall because the movie is so bad. So now, what options you have? You will not go and watch. So you have the right, when you buy a ticket, you have a right to watch the movie. Okay, but it is not obligatory on your part. So what is the amount which you are going to lose if you don't go and watch? In case if you don't sell your ticket, you are going to lose your 500 rupees. Okay, so you get a right to watch the movie, but you think it is not worth it, you will not go and watch the movie, and the money will be losing will be only the premium. So exactly it works the same way in the options. So you take a right, but not an obligation to sell the INR at 74 rupees. Fine. So if the INR goes to 77 rupees, you're not going to exercise the right. So you're just like not watching a movie. So you will not be bothered. You will be losing some money by taking this right. Okay, that is called the premium. If the INR does strengthen to 70, it will exercise the right to sell the USD at 74. Now it happens that the rupee goes to 70. Okay, so now you're going to get your money at 70. You don't like that. Since you have taken an option contract, you're going to exercise the right to sell your US dollar at 74, because you have gone to the stock exchange and you got a contract with someone to sell dollar at 74 to him. Okay, now the rate is 70, so you say, okay, I'm going to execute my contract, I'm going to exercise my contract, so here are my dollars, give me 74 rupees. Okay, so the other guy has to accept because he has taken the contract 74 against the US dollar to its option. Hence it will be able to hedge against the increase in the value of the INR, and its revenues will remain unaffected. So it's very important. So he gets the right, okay, to sell his dollars at 74, okay, but not an obligation. So if the dollar goes to 70, if the rupee touches 70, then he is going to exercise it, okay, somewhere like that. So he's going to still be protected. So his revenues are not going to decline. But let's say on the other way, let's say the INR weakens to 77 against the dollar. If the Infosoft exercises its options to sell at the strike price of 74, it will suffer a loss of 3 rupees for each option. If they exercise, they're going to lose. So why will they lose? They will not exercise the option because they have an option to do so. Since it does not make any sense to exercise the contract, it will forego the right to do so. In that case, the only loss the company will incur is the premium it has paid to enter into the contract. So in this case, if the INR weakens or the dollar appreciates, then this company is not going to exercise the option. Okay, fine. And why will not do? So they will simply, let the contract expire without, exercising it. So they are going to only lose the premium. So just like a cinema ticket, you have a right to watch it, but if you don't watch, nobody's going to say anything. You will be losing only the premium or the ticket price. So here also you pay the premium and you lose only that. So what is the premium? Well, to enter into any derivative contract, you have to pay a premium to the seller. The person on the other side will collect the premium from you, and he is called the writer of the contract. So basically, the two parties in this, one is the buyer, okay, who is called the holder of the contract. The other party is called the writer, the person who writes the contract. Okay, fine. So again, an example, you take an insurance against your car. Fine. So you have to pay a premium. Fine. And of course, it's a 1 year, insurance against your loss of, anything happened to the car. But if nothing happens, then the writer, the insurance company, is going to, the whole gain will be the premium which they have collected from you. But if you have some claim, then you can claim during the year. Okay. So the writer is like the insurance company, okay, who collects and gives you the insurance, okay, that if it happens, you can exercise, right? Otherwise, you lose the premium and the money will belong to the writer and it will be his total gain. Okay. So this is generally a fraction of the underlying asset. The premiums are normally not big enough. It's small. So premiums are determined by a host of factors. Now, how the premiums are determined? Okay. Premiums are determined by a host of factors like current currency value, the period between the contract date and its expiry, and so on. So there are lots of factors on which the premiums depend. The premiums can go high, can go low on many factors, and we'll discuss them shortly in our lecture today. But you might have done your derivatives also in your same subject, so you can recall that knowledge. We will again use that a little bit in our lecture today also. So types of options. There are two types of currency options, the put option and the call option. So, there are two kinds of option, the put option and a call option. A put option gives you the right, but not the obligation to sell a currency at a specified price on a certain date. So the above example of InfoSoft that we have used is that of a put option. Now here, they got a right to sell the dollars at, say, 74. Okay. So this is a put option. So this kind of currency option works best in a scenario when you expect the value of the currency like INR to strengthen vis-a-vis another currency. So we'll understand again that there's a call option and put option. Call option is only when it gives you a right to buy a currency, okay, and a put option will give you a right to sell a currency. So if you are talking about US dollar and rupee, and you are basically, an importer, so we'll talk about all these things when it comes through the questions. Okay, so we'll just do that a little later. Okay, so let's understand a little bit basics, and then we'll talk about more about all these details. The other type of currency option is called the call option, which gives you the right to buy the currency at a certain rate. Okay, this works when you expect the value of INR to weaken against another currency like dollar, or vice versa. When you expect the dollar to go up, then you should use a call option when you're talking about dollar and rupee example. And when you expect the dollar to weaken, then you use a put option. So put is a contract to sell, and call is a contract to buy. Okay, so you'll make money when call option is used when the rupee, the INR to weaken against the dollar. Okay, so we'll understand more through examples and questions later on. So now, what is the difference between options and futures? So there is a choice here. You can exercise your contract only if you find the price favorable. So in case of options, you will exercise your right only if you find it is favorable. In currency futures, there is no choice. you have to exercise the right. So that's a kind of a difference. So futures are basically linear products. So either you make losses or gains, okay? But here in options, you make a gain, then you exercise it. But if you are making a loss, then you don't exercise it. The only thing which you lose is the premium. Okay, you can just simply walk out of the contract. So they're not linear products like futures. In futures, you make either loss or gain. Okay, fine. But in options, there is a limited loss up to the premium, but unlimited gains. Okay, but in futures, you're exposed to unlimited losses as well as unlimited gains. So that's the difference. Okay. So option contracts, fine. So let's understand some definition of the currency options. Okay, currency option is also known as forex options. Is a contract that gives the buyer the right, but not the obligation to buy or sell a certain currency. So this is we're talking about the option. Okay, so it gives you the buyer the right, but not an obligation to buy or sell a certain currency. Okay, at a specified exchange rate on or before a specified date. Okay, at the rate which is fixed. Okay, but before a specified date. So it's a contract which gives the buyer a right either to buy or sell the currency at a rate which is fixed today. Okay, but this right is given you for a period of certain time. It can be a month, it can be 2 months. Okay, for this right, the premium is paid to the seller. The person who is writing the contract will actually demand a premium to give you this right. Okay. So currency options are one of the most common ways for the corporations, individuals, or financial institutions to hedge against adverse movements in the exchange rates. Okay. So there's a very important question coming in. I'll just see that. Before that, currency options are one of the most common ways for the corporations, individuals, or financial institutions to hedge against the adverse movements in the exchange rates. Now, the question coming is from Sumit Jain, and this is the most important question which we always face in our life. So question is, so why to take futures since options are more favorable? Now, when we are doing in practical, we find most of the time the options are very, very costly, hedging tools compared to the futures. Because in futures, you don't have to pay a premium. But in case of options, you have to pay a premium. And normally, the writers don't want to lose the money. Okay, the people who are providing you those options are called writers. They will normally, charge a premium to the extent that, you will not be able to make money. So just to, without elaborating much, so this is more of a practical side, it is about 80 to 90% of the time, the writers make money. And the people who take, call options and put options, they lose the money. So you will learn that, okay, as we go along. Okay, I'll be talking about that a little bit more. So actually, the game is tilted towards the option writers rather than the option buyers. So that's why, though it sounds to be very good that, the option gives you, but much better choice, fine. But since because they have become very costly nowadays and the game is heavily loaded towards the option writers than the option buyers. So that's why it's the case. Okay, so we'll come to that later. Okay, so types of options. So there are two kinds of options: call options and put options. Okay, so I told you the two options. First, we understood, the overall definition of the options, but now we are, segregating the options into two: call options and put options. Call option. Call option is an option to buy a currency at a specified price on or before a certain date. So call option gives you to buy a currency, okay, at a price which is fixed today on or before a certain date. Okay. Now all these dates and specified prices are decided by the stock exchange. When you buy a call option, the price you pay for it is called the option premium. So when you buy a call, the call option, the price which you pay is called the option premium. Okay. It gives you the right to buy that certain currency at a specified price called the strike price. So first, important terminology which you are hitting is the strike price. And we'll understand what is the strike price. I'll take you to the stock exchange and show you what is the strike price, okay? But a little later. So it gives you the right to buy that certain currency at a specified price called the strike price. So you choose the strike price, okay, at which price you're going to buy. So that choice is given to you, okay? Fine. If you decide not to use the option to buy the currency, you are not obligated to. Your only cost is the option premium. Fine. So in this case, you can just simply walk out of the contract. If you think the currency is not gone in your favor, so you can say, okay, I'm not going to exercise my right. So then in that case, whatever premium you have given to the writer, that becomes your cost. Otherwise, you have a chance to make unlimited gains. If the currency moves in your direction, then of course you can make gains. Now, let's talk about the put option. Put options are option to sell a currency at a specified price on or before a certain date. So this is, a selling option. Basically, if you want to sell a currency at a specified price on or before a certain date, this thing, but you get a right to sell. When you buy a put, the price you pay is called the option premium. So again, you have to pay a premium for taking this right also. It gives you the right to sell that certain currency at a specified price called the strike price. So the strike price is your choice. So you will be given a lot of options in terms of strike prices, and you have to choose one. And we'll soon understand what is a strike price, how they are fixed, and how they are determined, and who determines them. If you decide not to use the option to sell the currency, you are not obligated. Your only cost is the option premium. So a call option, a put option. Call gives you a right to buy, put option gives you a right to sell, but at a certain strike price for a certain period of time. If you don't exercise, what you lose is the premium, nothing else. So now, the important concepts about the options, okay? Important concepts. So please focus here. These are the most important part of our learnings, and this will clear all your concepts. The strike price, okay, which I was talking about. So we will dwell on this strike price, which is the strike price is given by the stock exchange, okay? And you have to choose. And how do we choose? We'll learn it very shortly. The option premium. Now, option premium is the money which you pay for getting the right, okay? The option premiums can be high or low, okay? It will all depend on many factors. And you might have done, Black-Scholes model through which the option premiums can be theoretically determined, okay? So though we'll not be discussing that more in detail, but option premiums is the money which is charged by the writers from you. The market lots. Again, the market lots is the same, which is there in the futures market, $1,000, 1,000 pounds, 1,000 euros, 1 lakh yen. Okay, so these are the market lot size in the options trading also. The expiration date. Okay, so we'll talk about the expiration date also. Okay, because they expire, they can be monthly contracts, they can be quarterly contracts, or they can be weekly contracts. So each has different expiry dates. So now the most important thing, in the money, out of the money, and at the money options. So money can be, in the money, at the money, out of the money, or it can be in the money, out of the money, at the money. So these are the three things which you should learn. Okay. So now I'll talk about all these things, okay, in detail. Okay. All these concepts, in the money, out of money, market lots, expiration date, strike price. Okay. So let's talk about that. So, but before that, there is a call buyer. The person who buys a call, he's called the call holder. Then the person who gives you the right and charges the premium from you is called the seller. Now it can be either you can be a call writer yourself, or you can be a call buyer. So it is out of the people who are trading in the stock exchange. Sometimes you become a call writer, sometimes you become a call buyer, depending upon what is your motive. A put holder, that means a person who gets a right to buy. Who gets a right to sell basically the foreign currency. So he's basically a put holder. He's a buyer of that right. Okay, fine. And then a put writer, the seller, the person who collects premium from the put holder. Okay, so a call holder, the buyer. Okay, put holder, the buyer, who they get the right, they buy the right to sell, and the call holder gets a buy to buy. Okay. Call writer who collects premium, put writers who collect premium. Okay, fine. So let's understand now one by one what is the strike price. The strike price is the price at which the buyer of the option can exercise the option to buy or sell an underlying security. So strike price is the price at which the buyer of the option can exercise the option to buy or sell an underlying security. So the price which you choose out of many given options given by the stock exchange. So the strike price denotes the price at which the buyer of the option has the right to purchase or sell the underlying. Okay. Now, the strike price, say for example, the strike price of USD INR for December contract at National Stock Exchange is currently available. Of course, December is gone now, but it was available at 73.50, 73.75, 74, and so on, and up to 77. So there were different, kind of strike prices which are available. And soon I'll take you to the stock exchange so that you can understand it well from there. But I'll just wait for a while because I have to complete some of the concepts before I can go, and you can really appreciate that. So these are the strike price which are available. So you have to choose one. Now you will be asking which strike price to choose. Okay, so the answer is coming very soon. So, the current spot price was 73.70 at the time when I made this slide, and December contracts were available at these. Okay, so these are the strike prices are different from the spot price. Now, please focus here. This is the most important part of the slide, a call option. Okay. Now, currently the spot price, which is seen on your screen, is 73.5. Suppose this is the price prevailing, say, today. Okay. That means $1 is equal to 73.5. Now, these are the three kinds of strike prices which are available given to you by the stock exchange. Say 73, okay, which is less than 73.5, which is 73.5, which is same as 73 point, which is the spot price. 74, which is more than the spot price. Now, this is called in the money. Why in the money? Because if you choose a strike price of 73, okay, you have chosen a call option, call option to buy something. Okay, so the rate is already 73.5. So you got a right to buy at 73. So to begin with, you're actually in a profit position of 50 paisa. So it is giving you the money right away. So it is in the money. Suppose the dollar goes from say 73.5 to say 80 rupees. What will be your profit? 7 rupees, which will be 80 minus 73 because you have chosen a strike price of 73. Isn't it? So it is already in the money. But if you choose a price 73.50, your profit will begin at 73.5. So it is at the money. If you choose 74, that means you're choosing out of the money call option. Your profit will begin from 74. If the dollar price goes to 75, you make a 1 rupee profit, as against a 2 rupee profit if it was in the money. So now you can choose, either in the money, out of the money, or at the. Now the second question really, why to choose an out of the money? Why not always in the money? Okay, the answer is coming. But before that, we look at the put option. Now here, the put option will be just the reverse. The spot price is 73.50, and the strike prices which are available to you are 73. This is the dollar price. Price in rupees terms. 73, 73.5, and 74. If it was 73 rupees, and if it go, you got a right to sell the dollar at 73. Okay, fine. So it is already 73.5. You're making a loss at the beginning. So it's an OTM. So let's look at the 74 here first. So you got a right to sell something at 74. Okay, fine. So the price is 73.5. So you make a profit straight away. Okay, suppose it goes to say 70 rupees. So you make a 4 rupees profit. Fine. As against if you choose a 73 option, you make a lesser profit. Okay, so in the money, out of the money. So this is the thing now. Now, what is dependent upon what strike price you should be choosing. Now, let's look at the bottom, the premium. So this is the premium, that is the paisa in terms of rupee, 75 paisa. This is 25 paisa. This is 10 paisa. So in the money will be the maximum in terms of cost. So if you choose an in the money strike price, you are paying 75 paisa as a hedging cost per unit of dollar. But if you choose far out of the money strike price, then you pay only 10 paisa. So what it will all depend upon. If you're very bullish, extremely bullish that the dollar is going to appreciate, then you will be, maybe you will be happy to choose an in the money call option. You will be ready to pay a very high amount of premium because you know that you're going to make money. But if you are very mildly bullish on the dollar, you think that you may even lose your money because the dollar may not appreciate so much. So in that case, because of the abundance caution, you may even go for an out of the money call option to hedge yourself. Okay, fine. So there, you're trying to reduce your cost of hedging. Here, your cost of hedging is the highest, but you should be pretty sure that the dollar is going to appreciate against the INR, because here you get the right to buy the USD, okay, the dollar. Suppose the example is that you've got a call option on dollar that you will going to buy it. So if you are extremely bullish and you're ready to bear a high hedging cost, then you should go for in the money option. But if on the other way, if you're mildly bullish, so same logic applies for the put option. If you're mildly bearish, if you're extremely bearish, then go for the in the money put option. But if you are mildly bearish, then you should choose out of the money put option, where you pay 10 paisa as a premium per dollar for whatever money you are putting at stake. So that is the most important part of the learning today. Okay, so so let me see. The means at every strike price there is a buyer and a seller of a call. Let's go to the market now. Okay, before we go for a break, let's see if something is there. Okay, so let's just complete this, then we go to the market. So number of strikes, so that means what are the number of strikes? Contract trading cycles. So here we are talking in respect to the Indian markets. So how the mode settlement takes place, what is the contract trading cycle and number of strikes. So there are minimum 12 in the money and minimum 12 out of the money strike prices, and one at the money. Okay, so there are total 25 call options and 25. So the word E has been added because in India we have the European options. Okay, so fine, we'll talk about the European options later. Contract trading. So there are 3 monthly contracts, there are 3 quarterly contracts, there are weekly contracts. So all sorts of choice is given to you to take a hedge. Whatever you want to choose, a monthly contract, a quarterly contract, or a weekly contract will depend on you. Mode of settlement is cash settle in Indian rupees. So there is no delivery happening. Like in futures, it is always this thing. So we talk about the European and American options a little better. So I'm just going to stop here and just take you to the market before the break. So let's go to the market. Okay, let me see if you are able to see the screen now. Okay, I think now you can see the screen. Please tell me if you're able to see the screen. Okay, so we are in the, this is a trading portal and we will go to the stock exchange. Okay, so I'll take you to the currency. Okay, currency trade here. So let's close this window. So I want to say place an order. Okay, so now we go to the options here. Okay, so we have the futures and options. So we are learning options. So we go to the options. So I hope the screen is visible. If it is there, please confirm. So the exchange, we have 2 exchanges, National Stock Exchange and the Bombay Stock Exchange. So we can trade currencies options in any of the exchange. So there is a buy or sell. So you get a buy. You can either buy or you can sell. So you can buy a call. Okay. You can buy a put. You can sell a call or sell a put. So all four options are given to you. If you buy a call, you call holder. If you buy a put, you call put holder. If you sell a call, you're called the writer. Okay. If you sell a put, you're again called the writer. Okay, fine. So then you choose the pair. Suppose the USD INR pair I'm saying. Okay, fine. And then you go for a contract. Okay, fine. Please select the exchange. Okay, so we are going to select the exchange, National Stock Exchange, and I'm going to buy a call, for example. Okay, so if I'm going to buy a call, I'm going to select a contract. So these are the contracts which are available. If you look, the current price is 73.14, and this is 8th of January, which is today's date. So the strike price is written here 72.50. 72.75. So there are various kinds of strike prices which are available on your screen for 8th of January. So they are host of factors. Okay, you can see it goes right, this thing. Okay, and then you look at the premium here. So this LTP is the premium. So for 72.50, the premium was 61 paisa. So already it is in the money. It's deep in the money. So the writer is charging you 61 paisa premium. But if you lower your strike price, the premium becomes almost half, 37. So if you're choosing out of the money call option, then it goes to 16. Okay. Then it goes like, if you want to, make it, 73, 74 or 73, the premium goes down to 0.0075. Okay. So then you can just choose your strike price. Suppose you choose this strike price, okay, any of them. So once you have done it, so you just select a contract. So here I'm choosing a strike price of 72.75, which is in the money. Okay. So where the premium is 37 paisa. Okay. So then this contract has been chosen. So now I have to choose, how many contracts. So 10 contracts I'm choosing. Then, since the market is open, you can choose even the market. Okay. So, and then you don't have to put a price because it will choose the market itself. Otherwise, if you're just putting a limit order, that means you want to decide at what price you're going to buy, then you choose the limit. Otherwise, you choose the market. So then I say submit. So I get this order. So where it says action is buy from National Stock Exchange. This is option USD INR 8 January, which is at the strike price of 72.75. And this is a call option, a European option. And the quantity is 10,000, 10 lots. Option type is market, since I'll be placing in a market order. And last trading price is 37 paisa is the premium which I'm going to pay. Estimated value of the order is multiplied by the quantity, multiplied by the total value, it's 7,27,000. Estimated premium, which will be debited to my account, is 3775 because I'm playing with 10 lots. Okay. So the contract expiry is going to happen on 8th of January, 2020. Okay. Order validity is 7th of January 21. So, okay. Now, since, so this is, so if I say proceed, then it will, so the market is open, not open at the moment, it's 8:31. So that's why it's not accepting the order. Fine, good. So that was all about, learning about the options. So let me just go back to my screen. Okay, so wonderful. So I think you have had some experience of going to the markets. Okay. So now, what we'll do, we'll just go for a break. And in the meantime, you can just put your questions. So after the break, we'll meet again. So it's a 5-10 minutes break. So we'll come back again. Okay. Thank you very much. See you in after 10 minutes. Okay, yeah. So, okay, we'll start our journey of understanding options. Okay, so there was a very good question which came from one of the students. So I'd like to address that also. So buying a call option is equal to selling a put option. Selling a put option. Okay, so we'll talk about that. Okay, so this is a very good question which has come from Sumit Jain. Okay, Sumit, you have been asking a very wonderful question. So I'll answer that question a little later, just a few seconds now. Let me just explain the difference between, hope I'm audible and you're able to listen to me and the slides are visible. Okay, so American and European options. So there are two kinds of options. Okay, the key difference between the American and European options relates to when the options can be exercised. A European option may be exercised only at the expiration date of the option. So there is a single predefined option point in time. An American option, on the other hand, may be exercised anytime before the expiration date. Now, that means the American option is more flexible. You can exercise your right anytime during the period of the contract. Suppose it's a 1 month contract, you can exercise it anytime you want. Whereas the European option can be only exercised at the expiration date, only at the expiration date. And India, we follow European options. Okay. Now, if you may be wondering that if you can exercise your right only at the end of the month, then how do you, really get out the options contract? And if you're making money somewhere in between, okay, because you get a right up to the expiration date in case of futures, but in case of European, you don't have that right to, exercise or square up your transaction. But there are ways. There are a way around to, book your profits and exit your European options also. So, but we'll learn that maybe a little later. Okay. So, but the American options are in some other countries, but in India, we follow the European options. Okay. At the moment, I'm not discussing how to exit an European option even before the expiration date. Okay. So, before we go into that, so let's talk about this question which came from Sumit Jain. Sumit, the question is basically buying a call option is equal to selling a put option. If you're hearing, please listen to me, and everyone. It's a very important, part of our learning of the options. When you buy a call option, when you're bullish, like suppose we talk about an importer who has imported some goods abroad in dollars. So he's short in dollars because he's not having those dollars. So he'll take a long position in the options market by buying a call option. Okay. Now, if he makes money, that means if the dollar appreciates, he'll start making money. Okay. So he's bullish on dollar, but whatever gain he'll make in a call option will offset his losses in his actual position, which is actually his imports, so that he remains hedged. Okay. So if he makes a loss because the dollar rises, he has to pay more price for his imports, but he'll gain in the call option. So that will neutralize, those losses. So that means he's a bullish guy. So which means, the call writer, the person, other guy who's actually charging a premium, he should have a bearish stance. Since he doesn't believe that dollar will rise, so he's offering you a premium, okay, and giving you the contract. Okay, he's an option writer. He's call writer. So a call writer is bearish. Similarly, a put buyer is bullish and a put writer is bearish. So a put buyer is what? Is bearish, and put writer is bullish. So now if you see a call buyer and a put writer, both are bullish, isn't it? But they are two different people, but they are both having a bullish stance. So they both have the same, direction in which the dollar will move. So both, now if you are hedging your imports, okay, you expect the dollar to rise. So you go to the market and find that the options premiums are very high, though of course you feel the dollar will still rise, but not that much. So you have two choices: either to go for an out of the money call option, pay a less premium, so that if you lose something, you will lose only a small amount, or instead of the premiums are very high, you can write a put option. Because though you are mildly bullish on the dollar, but you're collecting a hefty premium, so the chances are that you're going to collect a premium. Okay, because the put buyer will not exercise his right, and you're going to, your gain will be the premium which you collected from the market, which will hedge your foreign currency import transaction, because the dollar will go up a little bit, but those gains which are coming as a premium will actually, help you to hedge your currency transaction. So that means if you are hedging yourself, you can either buy a call option or write a put option. If you are hedging, for example, your export transactions, you can either buy a put option or write a call. Okay, fine. So for the same reason which I explained, so you can just elaborate that. So that is, very important learning for you all. Okay, fine. So that's why they are. Okay, so now another question coming from Sumit. CENP means European. Yeah. E means European, yeah. So because we write always E, followed by C or P, which means that we are following European options. Okay. Factors that determine the option. If you have understood my explanation with regard to the Sumit's question, whether the buying a call option is equal to a selling a put option. So if you have understood, say yes. And if you have not, ask me, I'll further elaborate later on. Factors that determine the option premium. Now, what determines the option premium? Because the option premium is very, very important. I told you if the option premium is high, okay, then instead of buying a call, you can write a put, okay, which will have the same thing. So factors that determine the option premium. Price of the underlying. So price of the underlying, as the underlying price rises, so does the premium. If the price of the dollar rises, then for the same strike price, the premium will also go up. Isn't it? Fine. So it's directly correlation that the price of the underlying, as the underlying price rise, so does the premium for that particular strike price will start rising. Okay. Today, suppose that 73 rupee 50 paisa strike price was costing you 50 paisa. But if the dollar rose to 74, so the premium will also go up, because now it will not be selling at 50 paisa. It will be selling at, say, at 1 rupee. Okay. Then the volatility of the underlying. That means how volatile is the currency pair. Let's talk about dollar versus rupee. If dollar versus rupee is volatile, we know, yes, sometimes the dollar goes up, sometimes goes down, but most of the time dollar is always on long term, it is going up. But there is a lot of volatility depending upon the inflow coming to India in terms of foreign currency investments, FDI, FI. In those periods, the rupee appreciates, but largely the dollar appreciates because there is a lot of demand of dollar. Okay, and the interest rate differential theory also says that. So there is a lot of volatility which happens between the dollar and rupee. Okay, so more the volatility, the premium will go up, because the chance of a call buyer making money depends upon the volatility. If there is no volatility, then how can he make money? Okay, how he'll exercise his option if the dollar doesn't move at all? So the volatility, more the chance the buyer of the option to make money. Okay, since the chance of making more money goes up, so the premium, the writers will charge more money if the volatility is very high. Now, volatility is of two kinds: historical volatility and implied volatility. Now, historical volatility is basically the volatility which we experience over a period of time, say 6 months, 3 months, or whatever. Okay, if it is not visible, let me just share again. Okay, is it visible now? I hope is it visible now. Okay, Chavi, I think it's visible, I believe. So I just, if it is visible, I'll start again. Factors that determine the option premium. Fine. First is the price of the underlying. If the price of the underlying, that means dollar versus rupee, if the dollar starts moving up against the rupee, then the premium will also go up for that relevant, okay. Fine. So price is very important. Price underlying goes up, the premium also goes up. But premium with respect to the strike price. Okay. So with that strike price, the premium will go up. Then volatility of the underlying. So volatile, the more the volatile is the currency pair, more premium, because the chances of call buyer and put buyer making money, put option, the person who has gone for a call option or a put option, if they bought a call option or a put option, the chances of making their money will be more if the volatility of the currency pair is high. So the writers will charge more premium, okay, in case of the high volatility. If the volatility is very low, then the premiums will be also very low with respect to that currency pair. Now, volatility is of two types, historical as well as implied. So please listen to carefully, because there will be some question which I'll be asking you later in MCQ section. So implied volatility is basically, if you want to know, like looking at a premium, how much volatility has been there in the price. If you remember, you had done your Black-Scholes model earlier in one of your chapters. So it tells you, tells you that, what is, because the premium depends upon a lot of factors. Okay. One is the volatility, another is the price of the underlying. And as we'll know, the strike price of the option, time remaining until that. So how much time is the contract for? So there are 4 or 5 factors which determine the option premium. So, implied volatility is the volatility which has been built by the writer in the premium. So if the writer is very conservative, or if he thinks that you lose money, so he'll try to build more volatility into the premium. So if suppose, for example, let me just give an example. Suppose between US dollar and Indian rupee, the volatility is say 5%. So we know that volatility is measured in standard deviation. So standard deviation is 5% between US dollar and rupee. Okay. Now, actually, the writer has built in 10% volatility into the premium. So which means that he's charging much higher, in the premium as far as the volatility is concerned, because the volatility will have a price in the option premium. Okay. So which should normally depend upon the historical volatility. But if the writer is charging much higher, double that into his premiums, so that is called the implied volatility, that which has been, calculated on the basis of the Black-Scholes model, how much volatility which has been actually been shown in the option price as against what is the past experience of volatility into that currency pair. So if you find implied volatility is more, other things remaining same, then it makes sense to write options rather than to buy options. Okay. Then the second is the strike price of the option. Okay. And then, if the strike price, as I know the strike price, if it is more in the money, the premium will be high. Okay. If it is out of the money, the price will be low. Time remaining until the option expires, which means, if you have more time, the premium will be more. Suppose you enter into a 1 month contract. Okay. So the writer knows that within 1 month, he has to make money. So as against 3 months, if you get 3 months contract, then the premiums will be high because you have 3 months time. Anytime, because of volatility and other factors, and because of the time itself, if all remains constant, the time itself is given to is very high. The chances of, the things closing in the money will be very high. So you will be making money. Okay. So time is very, very important. If time is less the premium. If time is more the premium. Okay. Because you have more chance of making money if the time is more. Okay. So these are the various factors. So let's not, spend most time here. So currency call options. So, and then we'll be doing some questions also at a later part. A currency call option grants the holder the right to buy a specific currency at a specified price. So that is what we've done. Is the call option. You get a right to buy. Okay. And the price at which you place your bet is called the exercise price. Okay. And it is always given for a specified period of time. Okay. A currency call option grants the holder the right to buy a specific currency at a specific price. Okay, this we have done. Now, this is, the call option can be in the money, at the money, out of the money. Okay. If the spot price is greater than the strike price, then we say it is in the money. Okay. Because if the spot price is 75 and you are chosen 74, so you have already started making money. If it goes to 76, you make a 2 rupees profit. So it's already 75. So you just want a 1 rupee movement and you make a 2 rupees gain. So it is in the money. Similarly, at the money, when you choose a strike price of 75. So as we know that in the money call options will always have a higher premium compared to the out of the money. It all depends upon what kind of a stance you have. But strike price you are going to choose. It depends upon how bullish or bearish you are. So similarly, a call option a put option. A currency put option grants the holder right to sell a specific currency at a specified price called the strike price within a specified period of time. Now, the put option can also be in the money, at the money, out of the money. If the spot price is less than the strike price, okay, so you say you are in the money. If you choose 76, your profits will start accruing at 76. If the price goes to 70, you make a 6 rupees gain. But actually the price has moved by only 5 rupees because the spot price is already 5. So you are making a gain right away, 1 rupee extra. So for that, you have to pay a high premium, but it will be called in the money. Similarly, an out of money will be just the opposite of it. Okay. So let's do a question now, a basic question, and then we go to some questions coming from your study material. And as I told you, these questions are a bit tougher. Okay, so before we go to the tough questions, let's understand a very simple one so that it will help you out to understand the most difficult ones in your study material. So this is just an example. So on 1st of July 2020, XYZ buys a USD call option for covering its imports at a strike price of 73.50. Okay, so while I'm explaining, if you're following, so please keep saying that you're following, you're understanding. If you are not understanding, so I'll just repeat. Okay, so keep saying after a few slides that you are understanding. If you're not understanding, so please raise a hand. Okay, so on 1st of July 2020, XYZ buys a USD call option covering its imports. Now, if you're an importer, okay, so you have a short position in your underlying transaction, so you should take a long position, and long position in option is call option. Now you choose a strike price of 73.50. The expiry date is 3 months ahead, that is 30th of August 2020. Okay, fine. So you have to make a payment on, say, 30th of August. Fine. So you have to make a payment on 30th of August, and the expiry is also going to be happening, say, after 3 months. The premium is 50 paisa on a call. So you pay a 50 paisa premium for entering into a right to, buy $1 at 73.5. Gain or loss on expiry at various levels of exchange is demonstrated below via a payoff table. Okay, so let's understand, if suppose at different prices, if suppose the spot price, actual price happens to be at what prices, how much money you will be making. Okay, what will happen to the fate of this call option? So let's look at it here. If suppose the spot price, look at the extreme left of this table, spot rate at dollar at expiry on 30th of August. So this is the expiry date. Okay, suppose it happens and you choose a strike price of 73.5. Remember that you have chosen 73.50 paisa as the strike price. Suppose it happens to be 72.5. So you're not making any gain. So that means the option is expiring out of the money. Fine. So option is expiring out of the money. Okay. Fine. So, you are not making any gain here. So premium is 50 paisa. So you're losing your 50 paisa premium, and you're not going to, not going to exercise your right. Because since it has turned to 72.5, because you wanted the dollar to rise and make money, okay, so it has gone to 72.5. So what you'll do, you're not going to exercise your right because it has expired out of the money, and you lose what is the premium. As I told you that if it is not interested, you can just let the option expire worthless without exercising it. Now suppose it goes to 73.5. Okay, though it is out of the money, at the money, but still you will not going to exercise your right. In all cases, you're going to lose the premium. Okay, fine. Up to this point, you're going to lose your premium. So here we are talking about only the option contract with respect to the stock exchange. Okay, fine. So then the moment, if suppose it happens to be that the spot rate at the expiry is 74, so which is close in the money. So you're making a 50 paisa gain. That means 74 minus 73.5. So you made a 50 paisa gain, but you have lost 50 paisa premium. Okay, because you paid it upfront. So gain loss is 0, but you're going to exercise the call option because you're going to claim this 50 paisa from the call writer. Okay, so you're going to exercise the option. In this case, you're going to exercise the option. Then let's check at 74.5. you make 1 rupee gain, but you lose 50 paisa on premium, so that is your cost. So net you gain 50 paisa, but you're going to exercise. In all the other cases, you're going to exercise your options because now the dollar is started rising. Though actually you are losing money in your real transaction because as an importer you have to pay much higher. Okay, but what happens is that you are gaining in the option contract. So here you gain 50 paisa, here you gain 1 rupee net of premium, here you gain 1 rupee 50 paisa net of premium. Fine. So that means whatever you're losing in your real transaction because you're going to go to the spot market and buy the dollar at say these rates. So at certain rates you're making losses, but because the losses will get neutralized through the gains which you're making the option trade. But remember here that here what is happening? If the rate is 72.50, you are going to get your dollars at you have to pay at 72.50. Okay, so you'll be very happy. But the price you have paid for that is because you hedge yourself, you are paying 50 paisa. So ultimately, you will pay less to the importer at 72, but added with 50 paisa, that means you will be paying 73 rupees. Okay, so let's see, understand there. Okay, so let's understand now what happens to the overall transaction. Payment to the importer at the spot rate on 30th. Now, suppose it closes at 71.50, you're not going to exercise your call. So you're going to lose your premium 50 paisa because it is out of the money. So net cost to the importer will be 72. Okay, so you're getting the benefit. The price is 71.50. Of course, if you are not hedged yourself, you would have paid at 71.50. Okay, you would have been very happy, but you took a hedge also to cover your risk. So the price of the risk is 50 paisa. So overall net cost to the importer is 72. So now here in all the cases, if the price remains say between 71 to 73.50, which is in your favor. Okay, but though you're going to, cost would be the premium, but your cost will slightly go up as the prices rise. Okay, fine. But you're still getting the benefit. You're not exercising your right of this thing, okay? Because you're gaining in the spot market and paying less to the importer. But now what happens later on? Say in these cases the price goes to say 74.50. Here your option gain is 50 paisa, which is coming from the earlier table. Okay, so this will actually reduce your if the spot price touches 75.5. Your option gain is 1.5. How? 73.5 minus 75, 2 rupees gain, 50 paisa premium gone down. So 1 rupee 50 paisa is your net gain. So overall, you are hedged at 74. So that means in no case you are going to pay more than 74. But if the dollar touches, depreciates, then you are going to take the advantage of that. So initially when the dollar was, at the time when the dollar was less, okay, so there was a chance that dollar would have closed at 71.5. Your cost would have been only 72. So you have the best of all the worlds. Here you are hedged. Your cost never goes above 74. But if you get the benefit, you take the benefit also. Okay, by not exercising the calls. Hope you have followed. When the spot exchange rate rises above the strike price, there are gains. When it falls below the strike price, there are losses, which are maximum to the extent of premium. Okay, so this was relevant to the previous slide, so which we have covered. So I hope you have followed this first example, which was concerning the exports. Okay, the question is from Sumit Jain. There is also no gain or loss to the importer like futures? No. Remember, I think you have not understood or you have not seen this slide. If you look at this slide, this guy is making a gain. Okay, but at the same time, he is hedging himself. Okay, his total cost never goes above 74. But in certain cases, he is making a gain. If the dollar instead of appreciating, if the dollar would have appreciated, importer would have lost the money. But he's not losing beyond a certain point. Okay, he's not paying anything more than 74. Even if it goes to 75.5 or 80 rupees, he's going to still pay at 74. Fine. But if it closes, below a certain price, say for example, 71 rupee 50 paisa. Now he's going to pay at 71.50. So that is his cost. But he has to add 50 paisa cost of the option premium which he has paid. So his total net cost is 72. So if you look at the first part, he is paying only 72. Okay, as against in all of the cases at 74. So he makes a gain here. Okay, so this is the gain which he is getting. That as an option trader, he makes a gain if the dollar depreciates instead of appreciating. Then he's not going to exercise his right. He's not going to watch the cinema. He's just going to lose the ticket. So he's lost the premium price. He's got the premium. So that is only going to be added to his total cost. Okay. So once the dollar starts rising, then, he will come into play. He'll just, exercise his call and limit his, exposure to dollar to only 74. So he's getting the best of the both worlds. Limiting his, total outlay in terms of dollars at 74. But if, the dollar is favorable to him, so he gets the favorable benefit also. That's why it is not the same. So in futures and forwards are not the same. Futures is a linear product. Forward is a product where, the option is a product where he gets the benefit also if the currency moves in the direction of the hedger. I hope you have followed now. Sumit, if you have followed, please tell me, or others, all others. So now let's look at, a transaction, an export transaction. On 1st October 2020, XYZ buys a USD put option for covering its export transaction at a strike price of 73.50. Okay. So basically this is 1st of October. So he's buying a put option for covering its exports. Now in exports, you're always long in dollars here, but you are buying a put. So that means you're just taking a opposite, view that if the dollar, depreciates, you will start making money. Okay, fine. But in your export transaction, you will be losing. So you're covered your both ends. The expiry date is 3 months ahead. That is 31st of December 2020. And the premium is same, 50 paisa on the put. Gain or loss on expiry at various levels of exchange is demonstrated below via the payoff table. Okay. So he has actually taken a put. Okay. He'll make money only when the dollar falls, when the dollar depreciates. Okay. So if the dollar depreciates, he's going to make a gain in the option contract, but losing money in the real market where he's going to get his this thing. But then if the dollar appreciates, then he's going to just lose the premium, but he's going to get the benefit in the real transaction. He's be very happy. He's got both the things covered up. Okay. So that's the difference between options and futures. So now let's understand one by one. Suppose the spot rate at the dollar, say on the expiry day, is 71.50. So what has happened? The rupee has depreciated, okay, or the dollar has depreciated, okay. So he makes a gain, isn't it? He makes a gain. It's in the money. He makes a 2 rupees gain. Okay, fine. He makes a gain because the strike price chosen was 73.5. So 73.5 minus 71. So he makes a 2 rupees gain. But he has paid the premium. So that means his net gain will get reduced to 1.50. And he's going to exercise the option. In this case, he is going to exercise the option. He is going to recover this 2 rupees from the call writer. Okay. And he will pay him the 2 rupee. And the call writer will take 50 paisa from him. So net call writer will lose 1 rupee 50 paisa. The put, here we're talking about a put, sorry. So put buyer will make a profit of 50 paisa and put writer is going to lose 1 rupee 50 paisa. Okay. Now, suppose it happens to be 72, 72.5. Suppose these are the rates. So all are in the money. So, a put buyer is making money. Okay. So he's going to exercise his option. So in this case, he actually, the strike price was 73.5 and the expiry was 71.5. So he's making a 2 rupees gain. Okay. Net of premium, he makes a gain of 150. Here he makes a gain of 1 rupee. And here he makes a gain of 50 paisa. His here profit was 1 rupee, but it gets limited to, because of the premium, 50 paisa, he makes a gain of only 50 paisa. But then what happens later? If the dollar is rising, so he's taken a bet on as a put buyer, so he will his profits will now go off. So he's not going to exercise his option. So he's going to leave it like this and lose his premium. So because here the option will not be exercised, it will expire worthless. Okay, so he will not be interested. So he'll be only interested when the dollar depreciates. Okay, so he'll be making money. While the dollar depreciates, he makes money in the options contract, but loses the money in the real contract, in the real underlying transaction. But if the dollar appreciates, so he makes the money in the real market, but in the options market, he just loses 50 paisa. That is a premium, nothing else. Okay, so he gets the advantage of an option contract. So let's now look at his gain and loss, total gain loss. So exporter to receive dollar at the spot rate. Suppose it happens to be 71.5. Okay, so he's going to receive 71.5. He's going to the to the bank and surrender his dollars and get 71.50. Fine, but he's going to get 1 rupee 50 paisa gain from the option market. Okay, from the stock exchange. So net his payment outflow will be only 73. Okay, so similarly, all these rates, even if the dollar depreciates, so he's making a gain in all the transactions, most of the transactions, but he's going to basically, the net outflow will be only 73 paisa. Okay, so now if it happens to be the dollar starts appreciating, so he's just going to not exercise his put option, and his the cost will go up to 74.50. So he's going to he's going to receive in this case he's an exporter. Sorry to just say that. So he is going to make money. Okay, at 75 rupees he's making 74.5. At 74.50 he's making 74. So he's making more money when the dollar appreciates. Okay, so as an exporter he'll make more money. So he's protected at the time if the dollar depreciates. So he has a hedge at 73, but he has an advantage if the dollar appreciates. Okay, and he will be just paying the premium, the cost. Otherwise, all the benefit will accrue to him. So he makes money. Okay, I hope you have followed. Just look at the slide once again. This gives you the dollar at various rates: 71.5, 72, 72.5. So which means, as an exporter, you will be very happy if the dollar closes at very high level. Okay, but it closes at a lower level, he is not happy, but his happiness will be restored because he starts making money in the option contract. So, though he's receiving money at 71.5, but he's getting 1 rupee 50 paisa as option gain. So his net is 73. So he never loses or gets money, less than 73. So he's hedged himself at 73. So that means the strike price minus the option premium becomes his hedging price. Okay, and then if the dollar rises, so he gets more money. Okay, as way of his exports receipts, because he's going to go to the bank and get 74 rupees from him. But since he has paid 50 paisa for taking a hedge, so his net overall inflow to the exporter will be 73. So hope you have followed. So is there any questions? Please do ask. Okay, so means when the option expires, importer exporter always gain in net import export transaction. So who is that? Sumit Jain. Means when the option expires, importer always gain in net import export transaction. Now this is also a question which you should ask yourself, whether he makes okay, if it expires, then he is basically he makes a gain in the sense that first of all he is hedged. Okay. Now, if suppose the dollar touches 75, fine. In this case of exporter, if he had not taken a hedge, he would have got 75. But since he has paid a premium, his total inflow reduces by 50 paisa. But if the dollar starts depreciating, so the benefit of that starts accruing to him because in that case he will be protected because of the option contract. So his overall hedging himself at 73 bucks. Okay, but he's had to pay a cost of premium. Okay, fine. So means option expires. When the option expires, importer or exporter always gain in net import. You can always make your own assessments of that. Fine, but it is right on your screen. Okay, so let's move forward. Okay, so let's do one very important questions before we come to our MCQ section. Okay. So I'll be just doing one question, which I'm thinking of doing this question. So let's just do first an MCQ and then move on to the last question of the day. Okay. So the last question is very important. So please stay tuned in, because the last question is the most important, which is coming right from your study material and a very tricky question. So please don't go away, and let's do an MCQ. Okay. So, okay. The first question coming to you is, A feature of the currency option that distinguishes it from other derivative is A, B, C, D. So tell me which is the choice, which is the right choice. Okay, so I'll wait for your answers. A feature of a currency option that distinguishes it from other derivative is it carries a premium to be paid upfront. It is optional to enter into a contract. The buyer has only a right but no obligation to execute the contract. The seller has a right but no obligation to execute the contract. Okay, so tell me what is the right option? So I'll just wait for your answers. You know, after this question, after this MCQ, we'll be doing a very important question. That is exactly after say about 10 to 12 minutes, we'll be doing a very important question. So we will be doing just a couple of MCQs, then we'll moving on to the question as I get my web at there. So, so I just want that you should answer these questions, okay, before we go to the important questions. So the feature of the answer is basically the buyer has only the right but no obligation to execute the contract. So the right option is C. A feature of the currency option that distinguishes from the other derivative is the buyer has only the right but no obligation to execute it. Okay, so the buyer has only right but no obligation to execute the contract. The seller has the right but no obligation. No, the seller is basically the writer. Okay, so he has an obligation all the time. Okay, so buyer will be the call buyer or the put buyer. So they have the right but no obligation to contract. Some people may think that even D seems to be okay, but D is not the right answer. So answer is C. Okay, so Sumit, the answer is C, and A, it carries a premium upfront. Okay, Chavi, your answer may be right. Okay, but what is a distinguishing feature? Okay, is that it carries a premium paid to be upfront. That is okay, fine. Your answer may be right in some one respect, but actually the main feature which distinguishes it from other derivatives, of course, in other derivatives you don't have to pay the premium, but the buyer, the most important one is the buyer has only the right but no obligation to execute it. And I think Sumit has well understood it, and no problem. Why not D? Okay, why not D, Sumit? So I answered this question. The seller doesn't mean the put buyer. The seller means the writer. The writer has the right. The writer doesn't have a right. The right is given only to the call buyer or put buyer. The writer collects a premium and then he has the mercy of the call buyer or a put buyer. So he has nothing. I mean, he has all the obligations but no right. Okay, his right is only to collect the money when it expires worthless. Okay, fine. The factors that determine the option premium are price of the underlying, volatility of the underlying, strike price of the option, time remaining until the option expires, or all of the above. Okay, so here I think by the time you would be punching your answers, so I'll just show you the answer. All of the above. It was a pretty simple one. Okay, so it is factors that determine the option premium are all of the above. Okay, so now we move to the third question. An option allowing the owner to sell an asset at a future date is what? A put option or a call option, a forward option, or a future contract? So please answer this. So I'm not receiving any responses from you all. Okay, yeah. Okay. So question number 2, EEE. Question number 2, all, yeah, EEE. Absolutely right. Question number 3. Okay. Question number 3 is A. Yeah, put option. Absolutely right, Preeti. Yeah, you're absolutely right. And your answer to E is also right. And Chavi, you're also right for your answer number 2. And Sumit, you're also right for answer number 2. So now we come to the 3 is right. Okay, so 4th, the amount paid for an option. The amount paid for an option is the strike price, the discount, the premium, the yield. So these are pretty simple. The amount paid for an option is what? The strike price, the discount, the premium, or the yield? Okay, the 4th one answer is C. The answer is C, which is premium. Yes, absolutely right, Preeti. Okay, so I'll be just talking about one question which is there, the last one. Okay, and then I'll come back to this thing. Okay, so what is meant by implied volatility of the S&P Nifty index? What is meant by implied volatility of the S&P Nifty index? This is an actual volatility of the Nifty 500. Okay, or Nifty say 50 rather. Okay. So this is the actual volatility of Nifty 50 index as computed from the historical price level, or it is using Black-Scholes option pricing formula. It is possible to use available market data after variable infer the variable standard deviation in this formula. This is deduced variable as referred to as the implied volatility of the underlying asset. Example, Nifty it is looking forward. It is basically a looking forward measure of volatility. So please look at this. So just focus. It is a forward-looking measure of volatility. That means how much the volatility the actual writers are thinking going forward. What should be the volatility? Okay, it's a forward-looking measure of volatility. It has been calculated through using Black-Scholes option following formula. This is the second choice. Okay, so tell me which is the better choice, the first one or the second one? 11th one. What is meant by implied volatility? Is it the historical volatility, or is it the volatility calculated using the option pricing formula, and it is actually based on it's a forward-looking measure of volatility? That means how much the writer is built into the premium. I mean, thinking that this will be the forward-looking volatility of the currency pair. Okay. So yeah. So please mention the question number, Nilesh. I think you're referring to the 3rd, then it's A is okay. But for A, 11th, what should be the answer? 11th, what should be the answer? What should be the answer for question number 11? If you remember, we did, the implied volatility and the historical volatility. Okay. So basically, the answer is here is B, which means it is implied volatility is nothing but the volatility which has been calculated using the Black-Scholes option pricing formula. It is a measure, it's a forward-looking measure of volatility and not the historical. Okay, so historical volatility is something different than the implied volatility. So I told you if the implied volatility is very high, then it makes best choice is to write either a put option or a call option instead of buying a call. So okay, yeah, answer is right. So who is given? Yeah, Sumit Jain, your answer is right. Okay, so now let's go to a question. Okay, I mean this MC part I'll come later if I have time. So we'll come to the important question. Okay, so this is the question. Okay, sorry for this thing. So this question was somewhere in middle. Okay, so let's do this question. Okay, so this is the last question for the day. It's going to take little time, and then there is some time left. We'll be doing some balance part of the MCQs. Okay, so exercise number 2, which is very, 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 very important. So please focus. And most of the questions are like this, where the options are coming into the, your questions. Okay, so XYZ Limited, a US firm will need 3 lakh pounds in 180 days. In this connection, the following information is available. Okay. Now there's a company called XYZ. It's a US firm. So they will be needing 3 lakh pounds. Okay, because they have to make a payment of 3 lakh pounds. So perhaps they're importers. So spot rate of £1 is equal to $2. 180 days forward rate of pound is as of today is $1.96. So the spot rate is given, the forward rate is given, and the exposure in terms of pound is 3 lakhs. So it's a US company which has to make a 3 lakh payment in how many days? 180 days. Interest rates are as follows. 180 days deposit rate is 4.5%. US it is 5%. So this is 180 days rate, not per annum. Remember, 180 days borrowing rate. UK 5%, US 5.5%. So remember, this is 180 days rate of interest, not per annum. A call option on pound that expires on 180 days has an exercise price of $1.97 and a premium of $1.4. Fine. So, this is the call option is what is trading currently at. XYZ Limited has forecasted the spot rate as 180 days are like this. Okay, future rate. So that means that this company has actually forecasted the spot rates after 180 days, which are there is 25% chance that the rate will be £1 will be equal to $1.191, and there is a 60% chance that the rate will be 1.195, and 15% chance that the dollar would be ending at that pound will be ending at $2.05. Okay, so P stands for probability. So they have forecasted. So this company says that these are the various chances of how the pound will behave. Okay, so these are the various chances of dollar moving. Then which of the following strategies should most preferable to XYZ Limited? So which of the following strategies would be most preferable to XYZ Limited? A forward contract. So we have the forward rates given to us. A money market hedge, the rates is also given. An option contract, no hedging, because we have the forward rates also. Okay, future rate, expected rate. So we can calculate, if no hedging is done, how much money they are going to. So this question is pretty long and very interesting. So there are 4 possible, analysis you have to do. So you have to find out, a forward contract, how much money will he has to, and money market hedge, option contract, no hedging. Okay, so show calculations in each case. So if you look at this, this guy is basically an importer. So he has to make a payment in terms of they will need 3 lakh. XYZ, the US firm will need 3 lakh pounds in 180 days. Okay, so fine. Okay, so then they have to find out, how much in dollars they are going to pay under each, situation, as a forward contract, a money market hedge, an option contract, or no hedging. So ultimately they have to pay in pounds, but they have to shell out in dollars. So we have to say how much will be the dollar outflow under each of the 4 situations. The least will be the one we should go for. Okay, so let's begin. So the first one is very simple, the forward contract. Okay, so dollar needed in 180 days. So we know that 3 lakh pounds multiplied by 1.96 is the rate. So the bottom of this is the rate is given. 180 days forward rate of pound is 1.196. So that means 1 pound is equal to 1.96. So 3 lakh pound will be equal to multiplied by 1.96. So since the quote is directly in order, if 1 pound is equal to $1.196, so 3 lakh pound would be simply by multiplying by 1.96. So we get $5,88,000. So first is a very simple one. In the first case, we found that the answer was a simple one. Okay. So this is the first part. So there are 4 things: forwards, futures, hedging, a money market hedge, and no hedge. So the first part is done in a jiffy. Second, Money market hedge. Now, what is happening? The money is going, money has to flow from America to England. So what you'll do, you will borrow the money in America in dollars, convert that into pounds, and invest that money in, in pounds, and repay those a dollar loan, okay, in 180 days, and repay the dollar loan in 180 days. So this is what you are going to do. Okay, fine. So this way you are actually going to first borrow in dollars, convert that pound, and invest the pound in basically in pounds. Okay, so and repay your loan in 180 days, which is in dollars. So let's say amount of pound to be invested. So how much pounds you are going to, first we start a little bit backward from here. How much pounds you to be invested in there? So it is going to 3 lakh pounds divided by 1.05. Okay, so that means this is the amount which you have to invest. So because you are going to first borrow the money in dollars, convert that into pounds, okay, and then invest this money in pounds. So here we are starting doing the reverse mathematics. So we are saying how much money should be invested so that it goes to 3 lakh pounds. Ultimately, you have to pay 3 lakh pounds because you should have 3 lakh pounds in your hand, say after 6 months or 180 days. So how much you should invest today? 2,87,000. So you divide by 1.46 so that it grows to 3 lakh rupees. So you must have these many pounds with you. So how you are going to arrange these pounds? You are going to borrow this in dollars. Amounts of dollar needed to convert. Now that means you are going to first convert that into dollars, and these are this is the money in terms of dollars you need to buy. So the current rate which is given as $1 is equal to 2 pounds. So you're going to get this as 5,74,000. So we'll go to basically the spot rate which is given is 1 pound is equal to $2. Okay, fine. So if 2,87,000 pounds will be equal to multiplied by 2, which is 5,74,000 pounds. So this is the pounds, this is the dollars you would be have to borrow in America. Interest and principal on dollar loan after 180 days. So since you have to borrow $5,74,000, $162,000 in US, and you have to pay say 5% rate of interest, so which is the 180 days borrowing rate is 5.5. So this will the amount will grow to 6,05,741. Okay, so this is the money eventually you have to pay in terms of dollars in America. So this is your dollar outflow in money market hedge. Okay, so you have calculated two. First, remember the first was basically the 5,88,000 when you're using a forward contract, but now in this case you are paying in dollars, which is 6,05,741, but you're using a money market hedge. Just to repeat again, the money market hedge is basically you borrow because the money has to eventually flow out of America, so that you borrow in dollars and take the money in England in form of pounds and invest there. Okay, fine. And then you pay off your loan. I mean, what you have to pay in terms of pound liability, and in home currency you will be paying your loan. Okay, in dollars. So the amount to be invested would be, that means you should invest this much of amount. Okay, so in 6 months time it will grow to 3 lakh pounds, which is your eventually liability. Okay, which you have to pay. Okay, so so this much of money you will be needing in pounds today, but in your own country you will be borrowing that money in dollars. So how much money you will be borrowing? 5,74,000, and then you will be putting that money. Will be borrowing. You have to actually borrow it for 6 months. The rate of interest is 5.5%, 180 days borrowing rate. So it is not per annum, but it is a rate for 5.5% for a 180 days. So the money will, you have to repay after 180 days on a loan will be 6,05,000. So this will be total outflow on account of money market this thing. Okay. So this is your outflow. So two outflows we have seen. So we find the forward rate so far is better because here the outflow is small. Okay. So then we come to a call option. A call option that expires in 180 days has an exercise price of $1.97 and a premium of 0.04. So we know that call option on dollar that expires in 180 days has an exercise price of 1.97 and a premium of $0.04. So here, you should look for this table which is coming to you. Okay, so now the company has done an expectation rate. So they say that expected spot rate in 180 days. So this is given in your question, that the company says the dollar can close at 1.91. Okay, so that means the pound will be equal to say $1.91. There's a chance that pound can close at $1.95 or pound can close at $2.05. So these are the three chances. Okay, fine. Then since you have taken a strike price of 1.97, okay, so what you have done, you have taken a contract. You have bought an option contract choosing a strike price of 1.97. Okay, so if it closes at 1.91, you are not going to exercise your option. You're going to lose the premium. So your total cost will be 1.95. Suppose it happens that the dollar goes to 1.91. Are you going to exercise your call option? No. So you will let it expire worthless. Okay. So what you paid, the premium, which will become your cost. Okay. So that means your total cost will be 1.95. Now, if we multiply this with 3 lakhs, we get outflow in terms of dollars will be 5,85,000. And there is 25% probability of this happening as per the question. So that means equivalent of that will be 1,46,240. Now let's go to the second option, that the pound closes at 1.95 pounds. Okay. Again, you're not going to exercise your right because it is well below 1.97. Okay. So you're not making any money. So you're not going to exercise. You'll let it expire worthless. And how much money you're going to lose? 4 paisa. So your total cost is going to be $1.99 per pound. Okay. In terms of dollars, it is going to be 5,97,000, which is 1.99 multiplied by 3 lakhs. And the chances is 60%. So that means equivalent of 60% will be $3,58,200. Okay. Then we come to the last one, which is very important. Here, what happens is the pound has closed at 2.05. Okay, 2.05. Now you're making profits. How much profit? 2.5 minus 1.97. 8 paisa you're making a profit. But you have paid a premium for. Okay, so that means the net gain will be only 4 paisa. Okay, so here this is the price which you are going to pay, but minus the gain. So net price will be 2.01. Okay, and then you multiply it with 3 lakh pounds. And probability is 50%. So overall outflow with this, option contract is be 5,94,900. So this is the chance. If you take an option contract, so chance is that you will be paying off 5,94,000. So how it has been arrived? So look at the gain. Gain on the option contract. Okay. So here the option the rate closed at 2.05, and 1.1 minus 1.7 was basically the exercise price. So this minus 1.95 minus the premium. Okay. So that means you're still making a 4 paisa gain. So this is the gain which you have made. Okay. And this is the money you're going to pay at the price which is prevailing in the spot in the market. So the gain, this is in the first 2 cases you are making losses. Okay. But they were getting neutralized because of a lower pound price. But here the pound price have appreciated, but you are making a gain here. So it will restrict your outflow to 2.01 only. Okay, so this is the calculation which is being done here. So then that means your total outflow on account of option will be 5,94,900. But since you pay the premium upfront, okay, which is 3 lakh pound multiplied by 0.04 is a premium. Okay, so that means $12,000 you are going to make a premium. Okay, fine. And add interest of 5.5%, which is the opportunity cost. Okay, so that means 660 you're going to add this up. So total outflow will be 5,95,560. So when you are using this option contract, if you understood, please raise your this thing and ask me a question. If you're not, I'll explain this again. Okay, so I'll come back. I'll wait for your answers if you have followed this. Okay, so then the net outflow I mentioned is 2.01. Okay, so net outflow in dollars will be 2.01, which has been mentioned here. Okay, fine. So if there is no hedge, If there is no hedge, we'll just simply take, the expected future spot rate per pound. Okay. So which is 1.91, 1.95, 2.01. Then, dollars multiplied by 3 lakh pounds into 1.91. So we get this multiplied by the probability, and then multiplied with the, expected dollar value, multiplied the probability with the pound. So we just simply add. So we get 5,86,000. So here there is no option. It is just we are using that. You see what would be the expected rate and what is each probability and how much money expected to be paid in dollar terms. Okay. So we find it becomes to $5,86,000. Okay. Fine. So now we can compare all of them. So forward it was 5,88,000. Money market hedge it is 6,05,000. Currency option it is 5,95,560. No hedge it is 5,86,000. So now see for yourself which is the least. You find if there is no hedge, that will be much better off. No hedge strategy appears to be most preferable because least number of dollars are needed under this option to arrange 3 lakh pounds. So here the answer is basically that it will be better not to hedge as per all the data which has been given. So I'll just sum up again. I'll just take you through the question again. So because this is a little bit so if you can look at the question again. Okay. So this company has to pay $3 lakh in how many days? 180 days. Spot rate today is 2. The forward rate is 1.96. The interest rates for borrowing as well as deposit rates are given. A call option which is going to expire in 100 days. The strike price is 1.197 and the premium is 0.04. Okay. So this is what the facts are given to you. Fine. And so XYZ has forecasted the spot rates 180 days. Okay. So those rates are with each probability they're given 25% chances that it will close at 1.191 and 60% chance that the pound is going to close at 1.95 pounds, $1.95 and 15% chance that pound will close at $2.05. Fine. So which of the following is strategy is preferable? All of the four. Okay, show calculations. The first one very easy. We look at the forward rate. So forward rate we simply multiply it with the pounds. We get the total outflow in terms of dollars. Okay, and the forward rate which is given is as 1.96, which is given in the question. We simply multiply and calculate the total outflow. Okay, and as far as the money market hedges, basically it is like first borrowing the money from the home currency, then taking the money into the foreign currency and investing there. Okay, and the money grows off to pay off the liability there, and ultimately whatever money you have paid for the loan in your own currency becomes your total outflow. So amount in pounds to be invested which should be this much. So that you invest today at 2,87,000, it go to 3 lakh pounds, which will help you to pay off your liability in terms of pounds. Okay, so that means this much of money you should borrow, but in terms of dollar terms, how much? 5,74,000. Okay, now since you're going to borrow this money, fine, in America, and you're going to pay 5.5%. So that means ultimately after 180 days, you're going to pay to your banker $6,05,000. So this will be total outflow on account of money market hedge. Okay, so all these rates were given to you. Then the tricky part was here, a call option. You took a call option. Okay, now why a call option? Call option is the right thing because you are an exporter. Okay, so you will always take a a call option. Okay, so you took a call option that expires in 180 days. So which has an exercise price of 1.97. Okay, at a premium of 4 paisa. Fine. So you will exercise only if it goes past, if the pound goes past 1.97. Okay. Before that, you're not going to use it will be out of the money. Okay. So the first two things are out of the money, 1.91, 1.95. So the premium was paid. So you are going to forfeit the premium. So writer is going to make 4 paisa per dollar. You're going to make nothing in this contract, but you're going to pay your outstanding at 1.91. So overall, your total cost will be 1.95. Okay. So you have to pay 3 lakh pounds. So which means overall you'll be paying 5,85,000. Okay. But chances of this happen is 1,46,000. So if it touches 1.95, the chance is 60%. So you still pay 4 paisa premium because you're not going to exercise your call option. It's still out of the money. Okay. So you're not going to exercise the call. So your net cost will be your total money outflow of 1.95 plus the premium. So overall outflow is 1.99. and in terms of dollars, it will be 5,97,000. So chances are 60% of that happening. So that means 60% chance of making a payment of $3,58,200 terms. But then we come to this one, which is the most important one. So the pound has touched $2.05. Okay, so you have made money. So it is deep in the money, closed. So you're making an 8 paisa gain. Okay, fine. But 8 paisa gain with 4 paisa premium. So net your gain is only 4 paisa. Okay. So you are going to make a payment at $2.05, but this is the gain which is going to accrue to you. So your net outflow on account of dollars, in terms of overall pounds, will limit to 6,03,000. Okay. So the chances of this happening is 15%. So in respect of that, it will be $90,450 outflow, 50% chance of that. So we take all the probabilities and all the amounts there and simply add them. So the chances is that your outflow will be 5,94,900. Okay. So I'm getting some questions from Ambika. Probability also represents the probability of exercising the options. No, not at all. Not at all. It is the probability of this thing happening. Fine. Other than the probability. Yeah, in a very indirect way, yes. But you may be right also. There is a chance, 15% chance. Yes, there is a 15% chance that you will be exercising your option, because in this case only 50% chance that it will be actually touching 2.05. So Ambika, what you're saying, if I correctly understand, this is the right thing what you're saying. There is a chance, 15% chance that you will be actually exercising the option, and 85% chance that you will not be exercising option because the option will close worthless. So you're bang on, absolutely bang on, Ambika. What is assessment is right. So add premium. Now, since you are going to pay a premium for entering into an option trade, and you paid a premium of how much? $12,000. Why? Because your dollar premium was $0.04. Okay, multiplied by 3 lakh pounds. So into 0.04. So total outflow on account of dollars in terms of premium will be 12,000 pounds, and that will get blocked for 180 days. And the rate of interest is 5.5% for the 180 days. So you just simply multiply, okay, and you get 660. So that means your total outflow. Okay, what is the concept of interest in call option? Okay, the concept of interest in call option is Anushka. Okay, Akansha Bhajan. Now, why we are saying is, what is the concept of interest in call option? Here, this is nothing to do with the option. This is nothing to do with anything. It is just to look at the your normal financial angle. If you are entering into a option trade, particularly if you're buying a call option or a put option, okay, you have to pay a premium, okay, upfront. That means right at the beginning, when you enter into a call option, you have to hand over the premium to the premium writer. Similarly, if you're buying a put option, you have to hand over as a put buyer, you have to give the premium right away to the put writer. So your money is flowing out immediately at the beginning of the contract. So that means it has happened 180 days before. So you have put your $12,000 given to someone for 180 days. Of course, it will become his, definitely. But this is an interest which you have to calculate, because this money has flown immediately out of your pocket. Whether you make a gain or loss, it's okay. But you have paid it immediately. The rest of the money which you're paying is happening after 180 days. Okay. So this money has gone out of your pocket at the onset, okay, upfront. So from the financial prudence, you are adding an interest to that. It is nothing to do with the concept of interest on call option. It's a normal financial concept that whatever you pay now, if you have to compare two things, if you pay now and you pay after 1 year, you have to add the time value to it to compare it. So this is just a time value, concept which we have used, because to compare the two things apple to apple, you should do it always. As a finance guy, this is the number one basic thing which we do, irrespective whether you're doing a call option or doing anything in the world. Okay, nothing to do with that. So this is basically the interest, which is a very small amount. Okay, don't worry about that, but it has to be considered nevertheless. So the gain in the option contract, this was the most important one, which I wanted to lay more emphasis on. There, the gain was what the dollar, the pound closed at 2.05 per dollar, and you have chosen a strike price of 1.97. So you are sitting on a profit of 8 paisa, 2.05 minus 1.97. But you have paid a premium of 4 paisa, so your net gain is 4 paisa. So if you are going to pay at 2.05, but you are going to make a gain of 0.04, so your net cost will be, in terms of dollars, will be 2.01. Okay, so for so many pounds, it will be coming at $603,000. Fine. So overall, this will be your outflow in terms of the option choice. Okay. So then we come to the no hedge strategy, where we simply take the expected rates and multiply it with the probabilities and calculate the dollar amount, and then just see that how much it works in total outflow of dollars. It works out to be 5,86,500. So then you have all the figures with you. Okay, all the 4 kinds of strategies. So the forward contract, 5,88,000. We know that. Money market hedge, 6,05,000. Currency option, 5,95,000. No hedge, 5,86,000. So we find which is the cheapest. No hedge, which is 5,86,000. No hedge strategy appears to be the most preferable, because here you are paying the least. So I hope you have all understood. And there is any questions, you can ask me. So this is the last thing we did for the day. Okay. If you have any questions, so I can just take on the questions. Okay, before we close the day. Or if you have followed, say yes. If you have understood, please let me know. So I'll be there for another 1 minute. Okay. Yeah, I'm getting some. Sumit, but in practical life, no hedge strategy in not to opt for. But in practical life, no hedge strategy in not to opt for. Okay. Now this is not always a right situation, Sumit, because sometimes now, for example, suppose you are you are expecting let's take an example of exports. Okay, so you are going to you export it to America, you are going to get $1 lakh in the 3 months time. Okay, but normally the dollar appreciates all the time. Normally it happens. Okay, fine, and you expect the dollar to appreciate in coming 3 months time. Okay, so if it is going to appreciate, then you may even not hedge it, because you will be getting more money if you don't take if you take a hedge. Of course, you compare the hedge, okay, and look at how much you expect the dollar to appreciate. Normally, we'll find that in case of exports, it will be always better not to hedge, because there is always a hedge, a natural hedge, because the dollars always appreciate against the rupee. So there is always a chance, a great chance, that we will not be hedging, unless the forward rates having a very good amount of premium, where you think that, okay, I'm getting a good amount because the dollar is appreciating, and that is reflecting in the forward contract. So let me take a forward contract. Fine. But if you think the dollar is anyway going to appreciate, so you are you may like to just leave it like that. Okay. So it all depends upon your view about the foreign currency, how it is going to behave. Okay. And if it is in your favor, without even taking a kind, because hedging always costs you. Hedging is always a costlier option compared to not hedging. So you must look at the cost benefit analysis of hedging your transactions. And sometimes, people don't hedge because of the cost involved in it. So that is not always that there'll be always a, by taking hedge, risk is mitigated. Yeah, by hedging risk, it is always, by taking hedging, risk is mitigated. Yeah, definitely. It's always advisable. I know by taking hedge, risk is mitigated. Why I say is that, you should always take a hedge, according to me, particularly for import payments, because, otherwise, as a businessman, you are more interested to know how much profit or loss you're going to make out of your business transaction. But if you on the above, you make either a loss or a gain, because of the foreign currency movement, if you make a loss, you will not be very happy about that. So you will like to have a peace of mind. Fine. So in that case, you will like to hedge yourself so that on the foreign currency movement side, whether you gain or loss, you're not bothered about it. Your botheration is how much money you're making out of your own business transactions. So this is something which you have no control. So you would like to put a cap on that. So it is always better to hedge. Of course, there are always pros and cons. I said hedging comes with a cost, but the answer is not very simple in all the cases. Okay, but hedging should always be done at times. Even the RBI and the government, they always tell people that. Okay, so now any other questions? So very good detail explanation. Thank you, sir. Okay, who was that? Srinivasan. Thank you, Srinivasan. If you have followed it, I'm very happy. Okay, if you say very good, it means you have followed. So that was my main aim. And then Pujita, Andrit sir, thank you so much. Okay, wonderful, great. And Chavi is also saying thank you, but simply a thank you. Have you followed? Were the explanations okay? So that is what I'm looking an answer from you. Chavi, you have been attending, I think, right from the beginning. And Sumit also, and Pujita, Srinivasan, you have been also attending, I think you. So great, you people are interacting and understanding. So that is my aim. So great. So we can just, if there is no other question, we can just sign off and see for the last, where we're going to do. Next time we are going to talk about, the fate of forward contracts and the nostro, vostro, and loro accounts. So these are the two things which are remaining. The rest of the things we have already done. So we will be left with, the fate of forward contracts. Okay. And the other topic, a small topic, is nostro, vostro, and loro accounts. We'll try to finish everything in the next class, which is going to happen on 12th of January. So see you all. Thank you very much.